schedule that will be used in the review of insurer filings for basic and additional coverage effective October 1st, 2016. The AIRB's mission as an independent body is to regulate rating programs of Alberta automobile insurers to ensure premiums are fair and predictable. So the work we are doing today is important work that will affect just under 3 million drivers and 70 insurance companies in Alberta. Before we begin, I would like to highlight a few housekeeping items. In the unlikely event of an emergency, an alarm will sound. The first alarm is normally just an alert. But please wait a few seconds and listen to the instructions given over the loudspeaker. When evacuating, please exit out of the room and go up the escalators that are to the right. Exit the building through the right-hand doors and continue south on 103rd Street, which is to my right, the way I'm facing right now, to the muster point located in the uncovered parking lot at the rear of the building. We'll wait for further instructions there if there is that unlikely event of an emergency. We have scheduled this meeting to run to approximately 2:30. We will take a short 10-minute break following Oliver Weinman's presentation and are planning to take a 1-hour lunch break from 12 noon to 1 p.m. Washrooms are located just outside these doors. If you have a pen handy, you might want to take these codes down. The men's room is 37852, and the women's is 25837. I'm just going to repeat that. Men's is 37852, and women's is 25837. And I would like to remind everyone to put your cell phones on mute for the duration of the meeting. Under the Insurance Act and the premium regulations, the Automobile Insurance Rate Board is required to conduct an annual review of automobile insurance trends and premiums related to basic coverage and additional coverage for private passenger vehicles. As part of this process, the board is holding this open meeting to hear from all stakeholders. The board has advertised this meeting on its website and in Alberta newspapers and has issued notices to stakeholders. The purpose of today's meeting will be to receive input to assist the board in analyzing industry experience in order to develop industry benchmarks for insurers and the board to use the development and review of rate filings. According to legislation, the board must consider industry-wide loss costs, administrative expenses, profitability, and other matters the board considers appropriate. The review will not address commercial coverage, complaints against insurance companies, or the insurance industry. Presenters and presentations that stray into any matters beyond the mandate of the board review will be ruled out of order by the chair and will be asked to refocus their presentation. Only those parties registered to present will have the opportunity to speak to the board, and copies of today's agenda along with our 26th annual report are available on the table for those interested. Members of the public or other presenters will not be allowed to cross-examine presenters. Only members and representatives of the board may ask questions of the presenters during the open meeting. This meeting forms one piece of the process through which the board will arrive at industry benchmarks for rate filings that will be posted on the AIRB website prior to October 1st, 2016. This meeting is being recorded to allow the board to review the comments made by presenters. Copies of today's presentations and the written presentations will be available on our website, which is www.airb.alberta.ab.ca following this meeting. In addition, we will upload a recording of today's meeting prior to August 31st, 2016. With that being said, I would like to start by asking each of the board members to introduce themselves, starting with Maureen.
Maureen Higgins.
Chris Daniel.
Alan Claren.
Neelam Jetta.
James Cumming.
Charlene Butler.
Also at the far table we have the AIRB staff, Vivian Cayo, Del Dick, Kimberly Kern, and Famo. Thank you. I would like to recognize the written submissions that the board received and will identify each for the record. The Cooperators Group Ltd., I believe Jim Mahoney is here with, thank you, and Intact Financial Group, Mike Crow, is he in the room? I can't see because of this post. So, and I don't believe we have a representative, but we have also received a written submission from Desjardins Insurance. Okay. So having completed agenda item 1, we will now move on to agenda number 2 and ask Mr. Ted Zubalek, the AIRB's consulting actuary, to come forward to present his report, review of industry experience. I might add this, his report has been posted, or a draft of the report being posted to the AIRB website on June 27th for review and comments by stakeholders at today's meeting.
Good morning. I notice that it seems to take me every year longer and longer to walk from that table to this table. It must be old age or whatever. Before I present our recommended benchmarks for private passenger automobile insurance for the board's consideration, I would like to share with the board what I believe to be some key observations from our review of the industry private passenger automobile claim experience through December 31st, 2015. At the top of the list is that we see bodily injury claim costs continuing to increase, and we see that happening in two ways. First, while our estimates of the claim costs that the industry will ultimately pay out for bodily injury claims that occurred in 2010, 2011, 2012, and 2013 and 2014 have essentially unchanged from what we had estimated in the 6 months ago in the 2016 semi-annual review. However, our estimate of the claims costs that will arise from claims that occurred in the first half of 2015 has increased by about 5.5% from our prior estimate, again, in 6 months ago in the semi-annual review. So that's one aspect of this increase in bodily injury claim costs that we're seeing. Secondly, bodily injury claim costs continue to trend upward at a relatively high rate, which we suggest is 7% a year. To put this 7% trend rate in some perspective, I note that what ICBC is using as a trend rate for the rate filing that it most recently submitted to in British Columbia is 6%, so 7%, 1 point higher than ICBC's 6% trend rate for bodily injury in British Columbia. And the 7% trend rate we're seeing here in Alberta is several percentage points higher than the trend rates that we observe in provinces like Ontario, New Brunswick, Newfoundland, and Nova Scotia. And the 7% rate is even higher than what's been experienced in the U.S. In the U.S., over the last 4 years, bodily injury claim costs have trended upward at a rate of about 3% per year. This is, again, many companies and across all states, but about 3% a year, although there has been a uptick in that trend rate over the last year. So the 7% trend rate that we're seeing for bodily injury claim costs in Alberta is relatively high. Now, what is driving this increase in bodily injury claim costs in the province is severity, the average cost per claim. Claim frequency has remained relatively flat over the last several years. Now, at past meetings, the board has heard from representatives from the industry as to what may be causing the increases in claim severity for bodily injury. And today, the board will again hear from IBC and others on this issue. Second point I want to make is that claim frequency has also been relatively flat for property damage and the collision coverages. However, in 2015, the second half of 2015, claim frequency actually declined by about 9% for each of these two coverages. That is, the claim frequency rate during the second half of 2015 for property damage and collision was about 9% lower than the claim frequency rate for the second half of 2014, a year earlier. Company actuaries that we've spoken to have told us that the lower claim frequencies that have occurred have been due to relatively mild weather conditions in the province during the second half of 2015. Now, if this is the case, and we'll have some information later to show you that we suspect that this is the case, then we may expect to see a rise in the property damage and collision claim frequency rates when weather conditions return to more normal conditions, perhaps in 2016. Third point is respects to comprehensive coverage. In addition to the high level of catastrophic losses reported by GISA over the past few years, and we've discussed this at prior meetings and we'll discuss this further today, there has also been a sharp rise in theft claims under the comprehensive coverage in 2015. Theft claim costs increased by about 50%, that's 50%, in 2015. And both claim frequency and claim severity have contributed to that increase. I think claim frequency for theft claims has risen by about 30 or so percent, and severity close to 15 to 20%, just in 1 year. And these increases in theft claims may be attributed to the economic conditions in the province. We'll show later the unemployment rate is running at about 8.6% right now. And lastly, a comment about interest rates. Interest rates, to no one's surprise, remain relatively low, at historically low levels. And this, of course, means that insurers have less opportunity to earn investment income, which in turn means that there's greater emphasis on underwriting income. And this could very well mean the board will be faced with more and more rate applications for rate increases to overcome the absence of investment income in the province. Okay, with that opening, I will now begin our discussion or my presentation on the industry benchmarks. But let's see if you think by now I know how to use this thing. Again, as the chair opened the meeting with his statement, the premium regulations require the board to conduct an annual review of the private passenger vehicles. And a component of that review is to analyze the industry experience and develop benchmarks for rate filings, for industry, to measure industry performance, and to calculate the rate level needs of the grid. On this chart, again, many of these slides are similar to slides that we've shown in the past, just updated. In the upper left-hand corner, we show the breakdown in a sort of a pie chart of the written premium in 2015 and 2014. The 2014 numbers are in parentheses, split between basic coverage and additional coverage. And you can see that the premium breakdown in 2015, the split is about 55% basic, 45% additional coverage, and a slight change from 2014. At the bottom right, you see the breakdown by claim costs. Now, these are our estimates of the claim costs for accident years 2015 and 14. But you can see the split is about closer to 60-40, 62% for basic coverage, about 40%, 40% for the additional coverage. So you can see there's a higher proportion of claim costs attributed to basic coverage as compared to the premium, which, all else being equal, would suggest that the basic coverage is more inadequately priced than the additional coverage in the province. We break down the claim costs for basic coverage into the three major sub-coverages: bodily injury, property damage, and accident benefits. And it's a little hard to see the numbers, but the bodily injury coverage represents about 62% of the basic coverage claim costs in the province. Property damage closer to 32, and then accident benefits, the balance about 8%. And the additional coverages break down almost 50-50 between collision and comprehensive. Of course, comprehensive the comprehensive percentage of the claim cost will vary greatly on the occurrence or non-occurrence of catastrophe losses. But in 2015 and 14, this is how we see the split. And the three minor coverages have 1% or less of the claim cost: underinsured motorists, all perils, and specified perils. Welcome. We need a bigger room. On this slide, we present some, as we have in the past, some economic statistics. As I mentioned earlier, the Alberta unemployment rate is now running, when we last looked at this, 8.6%, 2.5 point or so increase over a year ago, July, and not quite, but almost double the rate it was in 2013 and 14. The CPI, the total CPI, increased by about 1.5% or so over the last year, and the CPI, excluding energy costs, increased closer to 2% over the last year. So that's generally what, I guess, cost inflation is running at. Gasoline prices, which fluctuate perhaps daily, at least at the time we took this snapshot, have come down somewhat from where it was a year ago in August, and a little bit lower than it was in 2013 and 14. But again, the gasoline prices vary. Natural gas prices, a big drop in 2015, down to 94 cents. You can see how the numbers in past years looked, and they were even higher in prior years. The 3-year Canadian benchmark bond rates, again, hovering around 50 basis points for the last 2 years, a slight increase, but nevertheless, again, historically low levels. And we don't have information on the number of insured cars or population for 2016, but you could see 2015, almost 2.7 million insured vehicles in the province, 4.2 million residents. And graphically, we show the unemployment rate, and you can see how it's been increasing over the last few years, but thankfully, it's still a long way to go to reach the highs. But again, the trend is not good. Investment rates, again, you can see how low the current investment yields are compared to yields over the past 15 years. Again, as mentioned a couple of times now, historically low levels, and putting pressure on the industry to generate underwriting income. This is information we took right from a Government of Alberta Transportation publication. The government monitors collision rates, broken down per 10,000 population, broken down into various categories. I think fatal, it's hard for me to read, but fatal, other types of injuries, property damage only, and total. And you could see over the last 3 years at least, the collision rates have remained relatively flat. And as I will show you in just a little bit, that's consistent with what we're seeing in the property damage and collision coverages, fairly flat claim frequency rates. Okay. The industry benchmarks that I'll be going over presenting to the board this morning are recommended benchmarks, comprise the ULE provision, catastrophe loading, investment rate, health costs recovery, operating expenses, profit, loss development factors, and loss trend rates. And as I will mention as we get to the various categories, for a couple of these, we don't have any new information from GISA or the government, so our recommended benchmarks are unchanged from what they are currently. However, when that information becomes available, we either intend to change our recommendations and present new recommendations to the board, or the board will, like in the case of the health cost recovery assessment, probably adopt the new government assessment when it becomes available. We begin with the ULAE provision. Now, in determining their rate level needs, insurers should include provisions in their claim costs for what is referred to as allocated loss adjustment expenses, or ALAE, and these consist of expenses such as legal expenses that are associated with the settlement of claims. These are costs that can be attributed to specific individual claims, as compared to what's referred to as unallocated loss adjustment expenses, or ULAE, which are claim-related settlement costs or expenses that cannot be attributed to individual claims. They comprise mostly overhead costs, like the salaries of claim adjusters, or the rental costs of the claim department building, or whatever. Now, for the analysis that we perform, and companies are expected to use when they prepare rate filings to include or provisions based on their own experience for their ALAE and ULAE costs in calculating their rate indications. But for the analysis we perform of the industry-wide experience, we use the ALE provision is actually, those costs are actually included in the data that's reported to GISA, and it's included in the data that we analyze for loss development purposes and trend factors. That data companies report to GISA directly. Companies do not report their ULAE experience, and for that, GISA calculates a ULA factor based on some other report that they get from the industry. When I said that ULE is not included in their experience, I meant it's not included in the basic GISA reports that are issued, but ULE costs are collected by GISA, and they use that information to calculate a ULA provision by year. And we use that ULA provision to, or include or reflect that ULA provision in analyzing the trend experience. The board has in the past accepted the GISA's ULAE provision as a reasonable benchmark, and so we have, again, used, following that position of the board, we've used the latest ULAE factor for 2015, which is, as you see in the chart there, is 10.3%, and reflected that in the analysis we performed. There was some discussion about the appropriateness of the ULA factor from the standpoint of the way it's calculated by GISA and also the way it's used in our analysis. That discussion, I guess, occurred 1 or 2 meetings ago, but the board decided to stay with or accept the ULA provision calculated by GISA and the way it was used, and so and that's what we've continued to follow. No industry comments were received on this issue, and so our recommended benchmark for the 2015 year stands at 10.3% as calculated by GISA. The catastrophe provision. Of course, due to the unpredictable nature of catastrophic losses, which are defined by GISA as severe weather events, in determining their rate level needs, insurers should actually remove the actual catastrophic losses from their claim experience and replace those losses by a provision that represents an average annual catastrophic claim cost. And that provision that's reflected is typically done so through a factor that's applied to the non-catastrophic claim cost. Our recommended benchmark factor for the purposes of analyzing industry experience, which is based on the industry experience through 2014. Now, this is one of those reports that GISA has not yet updated. Actually, this report is expected, I think that we expect the 2015 report later this week. But our recommended factor had, in the last review, was 1.55, a provision that's equal to 55% of the non-catastrophic claim costs for the comprehensive coverage. The board did not accept our recommendation. The board's approved a benchmark of 1.45. However, I will point out that when the board reviews rate applications submitted by companies, it does encourage actually companies to provide and present their own catastrophic claim experience and to consider their own experience in applying a catastrophic loss factor. And the reason for that is that the catastrophic experience varies greatly depending upon where your business is concentrated. So the board recognizes that and considers an insurer's own catastrophic claim experience when it reviews rate applications. As I mentioned, the GISA has not yet released its 2015 catastrophic report. And again, I believe it will do so later this week, and when it does, we'll take a look at that and update our analysis. But for the time being, our recommended factor remains at 1.55. A few of the representatives from the industry that commented suggested, as they have in the past, that the 1.45 factor is much too low, and even the 1.55 factor that we've recommended is on the low side. IBC and other insurers, such as Desjardins and Intact, continue to find a rate of closer to 1.65 as being more appropriate. But again, we'll be looking at this shortly when the new experience comes out. I should mention, by the way, that we received, and I neglected to do so earlier, but we received comments, I think as the board chair mentioned, on our report from IBC, Desjardins, Cooperators, Intact, TD, and I mentioned IBC, of course, and FA. And again, I'm going to be referring to their comments as we go along here in the presentation. FA's comments focus more on how we arrive at our selected trend rates and how we perform our analysis and the information that we present in our reports. And I certainly appreciate FA's comments. I find them helpful, and as we have done in the past, and even for this report that we recently issued, we have considered FA's comments and made some changes to the way we do things, and we will continue to consider FA's comments in future studies that we perform. This is an exhibit from our report that shows, again, the numbers are a little bit hard to read, but shows the catastrophic claim experience for the industry through 2014, and you can see how the factors or the total number of claims all for the comprehensive coverage reported by the industry, the number of those claims that are deemed catastrophic by GISA, the percentage of claims that are catastrophic. You can see how the percentage varies from 4% to it looks like in 36%, a high of 45 or so percent, 47%, 48% in 2010. The amount of the non-catastrophic losses, the amount of the catastrophic losses, and what we call the catastrophic factor, which is the percentage. Essentially, what these represent are the percentage of non-catastrophic losses that are represented, or that are the catastrophic losses. So, for example, in 2014, that number of 178 million is 73% or so of the 243 million of reported non-catastrophic losses. And looking at we have various averages of factors over the years, and our recommended factors largely based on kind of in between the 10-year average and the average over the last 5 years. I believe, but I'm not certain of this, but I believe the IBC recommended factor is largely based on what's the experience over the industry over just the last 5 years. Again, when we get the updated report, we'll have a new year to add to the table, and we'll kind of recalculate things, and depending on what we see, we may change our recommended factor to for the board's consideration. Oh, by the way, I just talked about catastrophic losses. Just in today's Canadian Underwriter, there was a headline about July 18 to 20th thunderstorms in Western Canada, which of course includes Alberta, causing something like $89 million in insured losses, including vehicle damage. And the vehicle damage consisting of broken windshields, broken mirrors, and a lot of body damage. So it's a kind of a very typical event here to have these catastrophic losses in the province. Another point about the catastrophic losses, of course, there was the report that GISA releases this week for the 2015 report will, of course, will not reflect the Fort McMurray wildfire losses, and that's for two reasons. One, those losses, that event occurred in 2016, and this report, of course, will only be through 2015. But secondly, and I may be wrong on this, maybe IBC or someone can correct me later on, it's my understanding that the definition of catastrophic losses, the GISA's definition of catastrophic losses, refers to just weather-related events. I don't believe the Fort McMurray wildfire losses would be categorized or considered a weather-related event. So it may be that that event, which IBC estimates caused about if I'm right, about $180 million of insured automobile losses to the province, will not be considered a catastrophic event. But nevertheless, it's something that the companies need to consider in submitting their rate applications, and certainly whether or not it's a catastrophic event, per GISA's definition, it certainly hurt the industry's financial results in 2016. The investment income rate, again, commented on this a couple times now already, but the current benchmark rate is 0.95%, which and what this rate is used to discount. Companies are instructed or have to discount their claim costs as they for the investment income that they could earn on a risk-free rate, and that risk-free rate is currently 0.95%. At least the current benchmark is 0.95%, and that rate was based on, as has been the case in past years, the government of Alberta's forecast in future investment rates. Now, based on the government of Alberta's latest forecast of investment rates, we are now recommending lowering that benchmark to 0.65%. Again, we just work with the government's forecast, and it's a fairly straightforward calculation that we perform. We received some comments from the industry on that benchmark rate. In particular, IBC stated that it finds a rate of closer to 0.5%, 15 basis points lower to be more appropriate for all coverages. And if we're just looking at the basic coverage only, which has a kind of a longer payout period, they recommend a 0.6% basic coverage investment rate, benchmark investment rate for the basic coverage. Desjardins commented that it finds the investment rates forecast used by Oliver Wyman to be, quote, unrealistically high. Again, it's the first time I guess everything's relative, but it's the first time I heard a rate of 0.6% to be unrealistically high. And below I show actually the forecasted 3-month and 3-year bond rates that the government has most recently released, and they serve as the basis for our 0.65% recommended benchmark investment rate. Health cost recovery, I touched on this earlier. It's been the board's position to accept the government's most recent health cost recovery assessment as its benchmark for companies to use in calculating their rate level needs. The current benchmark is based on the government's 2015 assessment, which is 5.9%. The timing was a little bit different last year, but this year my understanding is that the government won't be seeing an updated of the government's 2016 assessment rate until later this year, perhaps the fall of this year. So it's unfortunate the timing is what it is, because by the time it comes out, it'd be almost 2017. And this leads to IBC's comment and suggestion, and that is that given the government's pattern or history of increasing the aggregate assessment every year, and since many of the policies that will be written under the rate filings submitted to the board during this 6-month window, October 1st, 2016 to March 31st, 2017, for over which time these particular benchmarks will be in effect, IBC feels it to be more appropriate for the benchmark, the health cost recovery benchmark, to reflect an anticipated increase in the assessment in 2017 and 2018. And Desjardins commented that it agrees with this, with IBC's suggestion. This is not a new recommendation. IBC has made this recommendation in past reviews, and the board has considered it, but nevertheless this has decided not to accept IBC's recommendation and continue to use as a benchmark the government Alberta's assessment rate, and as opposed to trying to anticipate what that rate is. So that is the board's current position. I assume it'll remain its position, but when that assessment does come out, as it has in the past, the board will adopt that new assessment as its new benchmark for the health cost recovery. Again, it's unfortunate that the timing is such that it comes out relatively late. It'd be much better if we could get the government to publish that assessment much sooner than it does. Operating expenses. The board's position has been to accept the latest industry average operating expense ratio as published by GISA as the benchmark for assessing the reasonableness of an insurer's rate expense provision that it reflects in its rate indication calculations. And by this I mean that the board, insurers should reflect their own expense provision, their own expense levels in calculating their rate level needs. The board merely uses this benchmark to kind of assess the reasonableness of an insurer's expense provision, whether it's too high, too low, and it just uses this more as a gauge, a benchmark, if you will. But again, the board expects companies to use their own expense provisions or their own expense levels and for those expense levels to be reflected in calculating their rate level needs. So this benchmark perhaps has less significance, less importance than some of the other benchmarks. The current benchmark is 25.4%, and that's based on GISA's 2014 expense report, including an adjustment that was made for the change in the premium tax effective April of 2015. GISA has not yet released its 2015 expense report, and I have no idea when that's expected to come out. Also in the fall, November-ish, October, November. When it does, I expect the board will, again, adopt that new expense level as its benchmark, again, that it uses to gauge the reasonableness of a company's expense levels. IBC has, and again, IBC has raised this issue before. The average expense ratio that's published by GISA is based on a weighted average of each insurer's expense level, and that weighted average is based on each insurer's direct written premium. IBC says or suggests that that may be inappropriate, that a better way of computing that average is to look at or consider each insurer's direct earned premium. And this is because there are insurers that are writing in the province that have business that are no longer they're operating the province, but they're no longer writing new business, so they no longer have direct written premium. They're kind of in runoff, yet they incur expenses. And when GISA weights based on direct written premium, those insurers' expense levels are not included in the average. And IBC finds that under a weighting based on an earned premium as opposed to written premium, that 25.4% would increase to 26.6%, a little over a 2-point increase in the average expense ratio for the industry. Desjardins says it agrees with IBC. And these are by category, how the components of the 25.4 and the 20.6.6 based on the different approaches to weighting the averages. Weighting the expense ratios. I guess I'm not convinced that what IBC suggests is appropriate. I'm going to give more thought to this, but I would think that for the way the board uses the expense provision, which again, just as a barometer, if you will, a perspective on the reasonableness of a particular insurer's expense cost, that it would want to use an expense ratio that's based on companies that are actively writing in the province as opposed to one that reflects also companies that are possibly in runoff. But again, we'll take a look at this again. IBC has put forth this recommendation before, and we'll look at it again, discuss it with GISA, but I tend to think that the way the average is calculated now is appropriate for the way the board uses the expense ratio. And the profit provision, the board the current position, as it has been for a number of years now, is to allow a profit provision of 7% of premium. No comments were submitted by anyone on the profit provision. I guess the companies would like to see or realize that sort of profit, but as a provision in the rate indications, there were no comments submitted. Okay, so that gets us to the final two, and perhaps the key benchmarks: loss development factors and trends. Begin with loss development. And just as a reminder to everyone, when I use the term ultimate claim amount, it's comprised of three parts. The actual claim payments made by insurers for claims that have arisen, the case reserves carried by insurers on individual claims. Every insurer puts up a case reserve on every claim that is reported to the company, and both the claim payments that companies make and the case reserves that companies put up are reported to GISA. The third component is what I refer to as the actuarial reserve. It's also referred to as an IBNR reserve or bulk reserve. Accounts for two things. One, claims that have occurred or accidents that have occurred for which the claims have not yet been reported as of, in this case, December 31st, 2015. And it also provides for deficiencies that may exist in the case reserves that are put up by companies. Just the way things are, but over time, as more and more information comes into each company, case or claim examiners or claim department personnel and that review the claims, they tend to find that claims are perhaps more severe than they originally thought, and the case reserves tend to increase over time, where the payments made on claims tend to be more than what was reserved. And so the actual reserve is intended to provide for that shortfall that may exist in the case reserves. Now, as I mentioned, loss amount factors are a way that we use to calculate or estimate what that actual reserve component is. As I mentioned, companies report their claim payments and their case reserves to GISA, but they do not report their actuarial reserves or their IBNR reserves or their bulk reserve to GISA. So we, in performing our analysis, need to come up with an appropriate or reasonable actuarial reserve for the industry as a whole. And we do so, using various actuarial techniques and whatnot. But at the end of the day, we end up deriving the factors that are used, that we apply to the reported payments and case reserves to estimate what the actuarial reserve should be for the industry. So, as I mentioned here, it's the application of those loss development factors that provide for the industry actuarial reserve that we use in our analysis. The benchmark factors that we are recommending in our study for the board to consider and adopt as a benchmark are somewhat higher than the benchmark and than the current benchmark loss development factors. And by this, what I mean is that our estimates of the ultimate incurred losses, again, these are the claim costs that the industry or all insurers on a combined basis will pay out on all claims that are reported, that arise from incidents that occurred on before December 31st, 2015. Our estimates are somewhat higher than they were 6 months ago. I mentioned that for bodily injury for the second half of 2015, our current estimate of the ultimate claim cost is about 5.5% higher than it was 6 months ago. For other coverage for PD, our estimate is about 5% higher, also for the second half of 2015, about 8% higher for medical payment coverage, about 4% higher for the disability income coverage. So for these basic coverages, our estimates have increased over the last 6 months. On the other hand, for the additional coverages for collision and comprehensive, our estimates are somewhat lower, about 6% lower for collision and about 9% lower for comp. But overall, our estimates are higher now than they were, which means that in hindsight, the loss development factors that we had recommended be used as benchmarks 6 months ago, in hindsight, have turned out to be a little bit lighter or lower than they in hindsight should have been. The second point about the development factors, and we discussed this in our report, there were some data issues that we had to deal with, actually struggled with, to address in order to come up with our recommended loss development factors for the bodily injury coverage. Over the last few reviews now, we've been, as a matter of course, been reviewing not only the industry-wide claim experience, the aggregate experience submitted to GISA and published by GISA, but we've also been looking at the claim experience of each of the top 10 or 11 writers in the province. Now, this information is available to us, but to no other, but to no other insurer. It obviously needs to remain confidential, so other insurers do not have access to the same individual insurer claim information that we have access to. But based on our review this time, we noticed the experience of three companies kind of stuck out, if you will, as being somewhat unusual. In the case of one company, the claim frequency, the number of claims that they were reporting in particularly the second half of 2015 were considerably lower than what they reported for the second half of 2014, more so than what could be attributed to favorable weather. I mean, it was a huge difference. So that obviously caught our eye. A second company, their case reserves, the losses they reported to GISA, again, payments plus the case reserve, significantly increased over what it was 6 months ago. That caught our eye, and this was a very significant increase. And a third company, their reported number of claims and dollars of claim losses was considerably lower than what they had reported also 6 months and even a year ago when we compare various years. And so this led us to contact each of the three companies, the actuaries of each of the three companies, to find out what was happening, because we felt that these changes, these numbers were so significantly, so different from what we would expect to see, that without some sort of adjustment, we would either overestimate or underestimate the ultimate losses for 2015 year in particular. So we learned that the first company simply changed the way it reports claims to GISA. It no longer reports small claims. So this was not a change in their claim frequency rate. It was just a change in the way they report claims to GISA. The second company greatly strengthened their case reserves. For whatever reason, they felt that the case reserves they were carrying were too low. They strengthened them, which is fine, And the company actuary would recognize that strengthening the case reserves in the actuarial reserve, all things being equal, the increase in the case reserves for that company would mean that the actuarial reserve should decrease. Well, in our case, since we're working with all companies combined, industry-wide data, had we not made some adjustment for that strengthening of case reserves, we'd be overestimating the industry losses due to the way that company increased its case reserves. And the third company was still not clear exactly what caused this, but for whatever reason, there was a drop off in the number of claims and dollars of losses that they entered into their system, because we found out through information provided by the company actuary that 5 months later, when looking at the same data from the accident year 2015, that the claim counts and dollars of losses kind of caught up to where they should be. So it's just a temporary lag, and again, we couldn't get a clear answer as to what caused that. But without some sort of adjustment, we would have underestimated the claim costs for 2015. So again, we, with information provided by the actuaries from these three companies, we made a best effort attempt at making appropriate adjustments for these changes, and when we did so and discussed those adjustments in our report. However, there are three problems. One, of course, adds to the uncertainty of our 2015 claim cost estimate. But secondly, as I mentioned, this is information that's only available to us. It's not available to the other actuaries representing other insurers, and because we have to protect the confidentiality of these three companies and their experience, we're not able to provide or present in great detail the adjustments that we made for other actuaries to review. So other actuaries really have to rely on our analysis in order to accept the board's benchmarks. They do not have the information needed to carefully review and closely review the adjustments that we made. So this is a bit of a problem. The second problem is that, yes, we were able to make these adjustments for the second half of 2015 because the adjustments or the changes that were made reflected only essentially 6 months or so worth of data. But as time goes on, these more and more data from these companies will be affected by these changes, and particularly the change in claim reporting and the case reserve strengthening. And this is going to make it much more difficult, if not impossible, to adjust down the road. So we have to give that a great deal of thought. We have a meeting scheduled with GISA in a few weeks to discuss this, to see if anything can be done. I'm not sure what can be done, or it may be, I think as FA suggested, something we just have to live with and ride with and accept that this is part of the uncertainty of the process. But at least for this time, we did make adjustments, and we feel the adjustments were needed, and as best we could, we think they were appropriate. This slide I've shown before to the board. It shows our estimates, as the height of each bar represents our estimate of the ultimate claim cost for the bodily injury coverage by accident year over time. So, for example, for accident year 2014, and this represents all claims, all bodily injury claims arising from accidents that occurred in 2014, our current estimate, as represented by the height of this rightmost bar, is that bar represents our current estimate of the ultimate claim cost for that 2014 year. 6 months ago, as represented by the left bar to the immediate left of that bar, is where we were, is what our estimate was 6 months ago. And a year ago, in the 2015 annual review, the height of that bar represents what our estimate was at that time. And you could see by the change in the height of the bars, at least over the last year, and when you compare these two bars, those two bars, those two bars, those two bars, and those two bars, as I said earlier, we haven't really changed our estimate all that much. I mean, a slight increase in the 2014 year, relatively flat by the same 2013 year, a slight decrease 2012 year, and little change in those two earlier years. Where we did see that increase, and you can't see it from this particular chart, is in the 2015 year. This bar represents what our estimate was for the first half of 2015 accidents 6 months ago. This bar represents our estimate of the full year 2015 as of the end of 2015. So you can't really compare the two bars, but had we just focused in on the first 6 months of 2015, this bar would be about 5.5% higher than that bar, and that's what I was referring to earlier. So if you look across, you can see how our estimates have changed over time, and if you look at the height of the rightmost bar of each year, that is a measure of the trend that we're seeing. And that's what earlier when I said there were two causes of or sources of the increase in bodily injury costs. The one was the increase in the height of the bar, if you will, and the other is the trend, the change over time, which is, we think, is running at about 7%. Within each bar, the different colors represent payments, case reserves, and the actuarial reserve. The dark blue represents, in millions of dollars, the amount of payments made by the industry as of that point in time. The case reserves represent the amount of case reserves carried by the industry on the individual claims that they report to GISA, and the actuarial reserve is the light blue shaded color. So you can see, for example, for our current estimate for 2014, $106 million has been already paid out on those claims occurring in 2014 by the industry. The industry is carrying $341 million of case reserves, and we think when all is said and done, all those claims are reported and settled, that the industry case reserves will prove to be about $287 million inadequate, and that's what our provision for the actual reserve is for that year. And you can see how over time, as you look back in time, more and more payments are made, and the case reserves and the actual reserve get smaller and smaller. Another thing that we can gain from this chart, if we take, again, as I mentioned, the dark blue shade represents the payments made by the industry. And if you compare for example, the 2014 year, as of the end of 2015, $106 million has been paid. A year ago, at the end of 2014, $27 million had been paid. So the difference between that number and that number represents the amount of payments made by the industry on bodily injury claims that occurred in 2014. The difference between that number and that number, 195 versus 92 million, represents the amount of dollars paid by the industry on claims that occurred in 2013 over the past 12 months. And you can go down the line and do the same thing. Now, if you calculate that difference, you'll get that for these years that we're looking at here, going back to 2010, the industry paid out about $450 million in bodily injury claim costs in 2015. And if we were to look at all the prior years, and keep in mind that there are still a number of claims still open and still to be paid for years prior to 2010, accidents occurred before 2009 and prior. If we add in the payments made by the industry in 2015 for those years, we get a total amount of payments made for bodily injury claim costs by the industry in 2015 of close to $600 million. And that compares to about $550 million of payments made by the industry in 2014 and about $500 million of payments made by the industry for bodily injury claim costs in calendar year 2013. So you can see even just the payments alone are increasing over time. Now, there are reasons for that. The increase in cars, the number of accidents, or this and that, but it gives you a sense of if we just wipe out all the claim reserve estimates made by the companies and their case reserves and me and the actual reserve, and just look at the actual payments, the payments are increasing for the bodily injury coverage, and fairly significantly over time. Which leads to our discussion of trends. Our trend rates are based on our analysis of the industry data through December 31st, 2015, including the adjustments that I discussed earlier and as described in our report for those three insurers. IBC has performed its own analysis of the same data, but without the adjustments to the bodily injury data that we made, again, because it does not have access to that information. But IBC did perform its own analysis and presented in their submission, which I will show in a moment, their estimated trend rates to be compared to ours. And TD also provided trend selections. Those trend rates that TD presented its submission were based on its own experience. And based on my look at those trend rates, are a little bit somewhat higher than the trend rates we are recommending serve as benchmarks. But in this chart we show, I compare for the basic coverages, the The current benchmark trend rates in the leftmost, or the left column here, those are the current benchmarks, are current recommended benchmark rates, which we'll discuss in a moment, and IBC's recommended or calculated trend rates. So you can see from this chart, we're recommending for the bodily injury coverage a 1 percentage point increase from where we are, what the current benchmark is, to that 7% that I mentioned earlier. IBC estimates 7.6%, a little bit higher than our trend estimate. Now, this could very well be attributed to, well, a number of reasons, but one reason may be because of those adjustments that we made that IBC did not make, and I think IBC, Dr. Miller's report, or commented on this in IBC's submission, that that may be a reason why we have this difference. Property damage, you can see we're recommending increasing for the current benchmark from 2% to 3.5%. IBC, somewhat of a surprise. It's rare that we're higher than IBC, but IBC's or Dr. Miller's calculated trend rate is 2%, same as the current. We'll look at the graphs in a moment, but it could very well be that whereas we are recognizing what we believe to be favorable weather conditions affecting the second half of 2015 frequency rate, where we're recognizing that maybe that IBC or Dr. Miller is not recognizing that decline in frequency as being due to weather to the extent that we are. Unfortunately, all I have are Dr. Miller's numbers, and I don't know how Dr. Miller arrived at his trend estimates. We're fairly close on the medical coverage, less than a half a point apart. Disability, this is one that we've always had a difference with IBC on. You can see we're recommending a 0% trend rate, a flat trend rate. IBC, Dr. Miller is recommending or suggesting a 2.9% trend rate is more appropriate. My guess is from prior submissions made by IBC that Dr. Miller, whereas we see the frequency rate for the disability income coverage as still declining, I think Dr. Miller is assuming a flat frequency rate, and that the 2.9% represents a severity trend rate only. But again, I'm not sure exactly how he arrived at his estimate. IBC provided no estimates for the more minor accident benefit coverages. And for the additional coverages, we're not too far apart on collision. IBC is a half a point lower. Now, comprehensive, we have not yet settled in on what our recommended trend rate is going to be. We're waiting for the 2015 catastrophe report to be published by KISA, again, hopefully later this week. And once that comes out, we'll finalize our recommended trend rate for the comprehensive coverage. Dr. Miller, I'm not sure the basis for his recommended trend rate of 1.7%, but it's higher than the current trend rate. Again, I don't know what he's considered in arriving at that 1.7%. I don't know to what extent he's considered the increase in theft claims. I do know that Intact recommended a trend rate of 2%, basically add 1 point to reflect the increases in theft claims that the industry is experiencing. Of course, if theft represents about 15 to 20% of the comprehensive claim costs, and theft is increasing at a rate of 50% a year, we need more like a 10-point increase in the trend rate to cover that than a 1-point increase. But it's unlikely that theft would continue to increase at such a high rate. And again, IBC has not presented any recommended trend rates for the other more minor additional coverages. I commented earlier about the reasons that have been brought forth or presented by various industry representatives as to the cause of the bodily injury claim cost increases. The board will hear from IBC and I think others today about these, the causes of these increases. But from the written submissions, we know that IBC has and others have provided some reasons. Again, I think we'll be hearing more about this later. The erosion of the minor injury cap, perhaps attributed in part to the Sparrowhawk decision, and more recently the McLean-Palmer ruling that's been cited as a possible cause of future increases in the bodily injury claim costs. Increased legal representation and use of strategies to avoid cap limitations has been cited. Psychological impairment, allegations of head injuries, chronic pain. one company, I forget which one it was, commented on the inefficiency or uncertainty of the current certified examiner process. And lastly, one company, I think, cited a maybe it was IBC, but high prejudgment interest awards as also contributing to the increase in the high bodily injury claim costs. I mentioned on a couple occasions now the weather conditions in the second half of 2015 and how it may have contributed to somewhat favorable claim frequencies in the second half of 2015 for the property damage and collision coverages in particular. And you can see here we pulled some information from government website, the weather website. We just added up the snowfall in Calgary and Edmonton, which were the only somewhat, we think, reliable sources of snowfall information from this website. Combined the two snowfall levels in those two cities over the second half of each year, beginning with 2006, and you can see how the 61.5 centimeter level in the second half of 2015 compares to prior years, about half of what it was in 2014, almost a third of what it was in 2013, and you can see you have to go all the way back to 2007, second half of 2007, to find a lower amount of snow precipitation in the province. So this could very well be contributing. We believe it to be the case. Again, other actuaries have said so also. Certainly contributing to the decline in frequency experienced for the property damage coverage. This represents a decline of about 9%, and for the collision coverage from 45.1 to 41.2 claim frequency rate, also a decline of about 9%. So if indeed, as we think is the case, we're not certain, but we think is the case, these favorable frequency rates are caused by the very good weather conditions. If 2016, for example, were to have a more normal level of snow precipitation, we could very well see these claim frequencies rates for property damage and collision increase a fair amount. So graphically, I'll try to run through these as quickly as I can. I'm going to now present graphically the claim frequency, claim severity, and loss cost data by coverage that we considered in arriving at our trend or recommended trend rates. The yellow line, which is hard to see in this particular chart, you'll see more clearly in the next one, represents our estimates of the claim frequency rate for bodily injury from a year ago, the 2015 annual review. So based on the year-end 2014 data through December 31st, 2014. The blue line represents our current estimates of the claim frequency rate for bodily injury frequency by accident year. And you can see we're pretty much unchanged. We haven't really changed our estimates of the claim frequency rate all that much. You can barely make out the yellow line maybe here, there's slight changes, but basically we're about little change from our prior estimate. And what you can see, though, is what I commented on earlier, that the claim frequency rate for bodily injury has remained fairly level over the last several years, relatively speaking. Severity, where we have revised our estimates of the average severities by year, the average cost per claim since a year ago, as depicted by the difference between the blue and yellow line. We've actually, in some cases, lowered our estimates of the average severity by accident year, and in a couple of cases, it's hard to see here, slightly increased our estimates. And as I said earlier, for the first half of 2015, we increased our estimate by about 5.5%. But you can see for severity, following a dip, and I'll come back to this in a moment, following a fairly sharp decline after following the 2004 reforms, when the minor injury regulation was introduced, severity has gradually worked its way up, been increasing over the years, and to where it is now, close to $60,000 per claim. Loss cost, which is a combination of frequency and severity, it's actually the claim cost per insured vehicle. You can see here, again, reflects the same frequency and is a reflection of the frequency and severity trend patterns that we just saw. Again, following a period, a decline, and following the reforms, a fairly flat loss cost pattern until about 2010-11, and then a change in the trend rate, a swing upward, and it's been increasing ever since. And this kind of coincides with that Sparrowhawk decision. What's interesting, and by the way, the red line that I've drawn in here simply is a way to show the board what a 7% trend rate looks like. I simply placed the red line on the 2011 data point and increased it by 7% a year. So you can see how a 7% trend since 2011 corresponds to the actual claim experience, at least as we've estimated it to be. One thing, and I should have included the 2003 year on the chart, but one interesting thing to note is that in 2003, actually the second half of 2003, just prior to when the minor injury regulation was introduced in 2004, the average bodily injury claim cost, the claim cost per insured vehicle, was $365, right about there. And lo and behold, where are we now? Second half of 2015, we're exactly, per our estimates, at $365. So we're back, it took us 12 years to do so, but we're back to the level of claim costs or loss costs that the province was at just prior to the introduction of the minor injury reforms. And for some perspective, over that same 12-year time period, the property damage claim costs have increased by about 65%. So the minor injury regulation worked in that it kept, at least for 12 years, the loss cost, the bodily injury claim costs under control. But again, we're losing steam here. And part of this increase is because we are no longer benefiting from the decline in frequency rate that was experienced in the province up until 2009-10. With the flattening of that frequency rate, the loss costing is being driven solely by the severity increases, which have been going on since about 2011 at a rate of about 7% a year, we think. Property damage, again, as I mentioned, it's been following increases through about 2010 or so. Property damage claim frequency has been fairly flat. I mean, all these data points are subject to variability, but fairly flat, perhaps a slight decline. But again, here's that sharper decline in 2015, primarily driven by the second half of 2015, where, again, as I said, the claim frequency rate dropped by about 9%. Claim severity for PD, again, has been steadily increasing since about 2011 or 10 or 11 or so. You can see, as depicted here, that our current estimate for the 2014 year is higher than it was a year ago, as you can see by the gap between the yellow line and the blue line. And you can see our current estimate is at an average cost per claim about $5,500. When you combine the two, the loss cost pattern, you can see since 2011, again, subject to variability, and there are many ways to look at this, but we are, based on this information, we are recommending a 3.5% loss cost trend benchmark for the board to adopt. It's depicted by the red line to some extent, and you can see again how the red line is much higher than the blue line, and that's because we have, as I mentioned, discounted, if you will, the favorable claim frequency experience during the second half of 2015. So we think when the weather returns to more normal conditions, that claim costs will move up closer to where that red line is falling now. Again, IBC, I don't show it here, but IBC's recommended 2% trend rate would be much flatter, less of a slope than the red line. And my guess is that the IBC gave this point much more weight than we have in our analysis. Now, I will be kind of reflecting a little bit more about the IBC's recommended trend rate before we present our final recommendations to the board, but that's where we are now. We're suggesting 3.5%, IBC at 2%. Medical, again, a smaller coverage, again, less than 8% of the claim cost. But you can see medical frequency has been, again, subject to some variability, relatively flat over the past several years, a slight decline in 2015. The severity, though, has been increasing. And you can see here that how our current estimate is quite a bit higher than what we were 6 months ago. The claim cost for medical came in more than we anticipated based on the development factors that we had selected. It turns out, in hindsight, our actuarial reserve, if you will, was too low for the year 2014 and the first half of 2015, and you can see how now we are estimating the average cost per medical claim to be higher than what we previously had thought. And the claim cost trend, you can see how we have selected a 3% trend rate based on this experience. IBC, as I mentioned earlier, close to our recommended trend rate. I think they're at 2.6%, slightly lower than us, but nevertheless fairly close to our recommended trend rate, again, based on the experience we're seeing. Disability income, again, fairly flat, actually flat. It's hard to tell because of the scale, but there's actually, the claim frequency rate is actually declining, and I think it declined by about 8 or 9% in 2015. Severity for the disability and coverage, however, somewhat variable and jumpy, has been generally increasing for quite a number of years. And you can see, again, how our current estimate of the average severity for the disability claims is higher than it was 6 months ago. The data that's come in is just worse than we thought. And when you combine the frequency trend that we just looked at and the severity pattern to get the loss cost pattern, you can see a very variable line as depicted by the blue line, a variable trend, if you will. Very difficult, in our opinion, to measure or calculate a trend rate from this. We are recommending a 0% trend, just too variable, not well supported by the statistics that we look at. IBC, again, as I mentioned, is recommending a 2.9% increasing trend. Again, we think because, and we're not sure, we think IBC is assuming a flat frequency trend for disability coverage going forward, as opposed to the negative trend that is reflected in our overall 0% loss cost trend recommendation. Collision frequency, we again subject to variability, the declining pattern, but somewhat, if you will, flat over the last couple of years, and again until 2015, where again, due to, we think, the favorable weather conditions, the claim frequency dropped by about 9%. Collision severity has generally increased over the years, fell off quite a bit in this period of time here, and then since has continued to be increasing, and we're recommending a 4% trend, half a point lower than than the current benchmark trend, and about a half a point higher than what IBC is recommending. And again, you can see how what a 4% trend looks like when plotted directly on the 2011 data point, and compared to the experience that we have seen the industry have over the last few years. Again, that gap is because of we think when the weather returns to more normal weather conditions, that the loss cost is going to increase due to frequency. And lastly, comprehensive, again, graph here is a little bit different than the prior graphs. Here we show just our current estimate of the comprehensive claim frequency, and in a moment we'll show severity and loss costs, but broken down to 3 categories. The dark blue line represents our estimate of the comprehensive claim frequency by accident year, including catastrophic losses. So you can see, largely due to the occurrence or non-occurrence of catastrophic losses, how the claim frequency rate varies over time. That is all. So the blue line is all losses attributed to, or that come under the comprehensive coverage. The brownish line or orange line that we have here is the theft frequency experience, and it's difficult to tell because of the scale here. But that frequency rate in 2015 is about 30% higher than it was in 2014. So as I mentioned, theft experience has been sharply rising, but you could also see from this graph that we haven't quite hit, it's not as high as it was, the theft frequency rate was some years ago in 2006, 2007. Now there's been a change in deductibles, so that kind of makes the comparison a little bit difficult to draw any conclusions from, but nevertheless, the important point here that we want to make is theft claims frequency rate is on the rise sharply. And the green line represents all other coverages, so just the difference between the blue line and the red line, or the orange line. When you look at claim severity, you could here theft clearly stands out. The average cost per theft claim is a lot higher than the average comprehensive claim as depicted by the blue line, or other than theft claims as depicted by the green line. Theft claim average severity close to $12,500, $13,000 a pop. You can see clearly a steady increase, a steady trend in theft severity over time, but in particular, in 2015, claim severity increased by about 20% over what it was in 2014. And when you look at the loss cost, the combination of frequency and severity, here you can see a little bit more clearly how theft has risen. Actually, the rise in theft began 2013, 2014, but just increased significantly in 2015. We're going to be, once we get this new GISA report with the 2015 data, we're going to be taking another look at not only the catastrophic provision, claim provision, but also the catastrophic or the comprehensive trend rate, and recommending it to the board in our final report what we believe that benchmark rate should be. But again, the concern here is what's happening with theft. Again, that just recaps the differences in our trend rate selections with those of IBC, and that, Mr. Chair, concludes my presentation.
Well, thank you, Ted. Are there any questions from the board for OW? Yeah, go ahead, Chris.
Sorry. Just on the theft issue, I read in Thompson's, I think it was in the first part of this year, that there was a major bust on a car ring theft. And I think it was the largest in Canada that they'd ever run across. Did you come across that at all?
I've saw many articles on the theft. I don't recall that one in particular. Maybe IBC is more familiar with that.
Maybe I'll...
But I gather your question is whether or not that ties in with the...
whether there is any correlation, and I have no idea.
Yeah,
so
I don't know
whether there would be, because it seemed to be a huge car ring that was the RCMP had uncovered, and it seemed to have a fertile ground in Alberta, whether it was because of the cars or whatever.
Yeah, I don't know.
Okay.
Ted, in your presentation, there were a couple times you said when the weather returns to normal.
Well, maybe, okay.
And I was just wondering if you had any statistical...
No, I don't have, I didn't bring my crystal, no, I don't know, and maybe I should have been more careful in my words, but if the weather conditions return to the longer-term average, and if indeed the drop in frequency is due to the dry weather conditions experienced in Alberta in the second half of 2015, then one would think that under less favorable weather conditions, the claim frequency rate would bounce back up. Mm-hmm. But I have not done any studies to correlate weather conditions with frequency rates. A lot of people here, this is before many of those that are on the board were on the board, but years ago the board had a discussion of this issue, how weather relates, and we didn't draw any conclusion. We didn't conclude anything. And one of the problems is that the weather data is just not very reliable. As I mentioned, I think only for the cities of Edmonton and Alberta do we have a long enough history to look at. But so many cities that the weather folks report on have gaps in the data. You'll have numbers for certain years and then no numbers for other years, and you just can't use that data for any sort of study. So it's more conjecture. And,
okay. I was hoping you had some other visibility.
I do know that ICBC has done a study or some sort of correlation of whether they have better data up there, perhaps in BC, and they did find that dry weather conditions are correlated or associated with favorable claim frequency, which is what this one data point seems to suggest.
Any other questions from the board? Well, either due to good management by the chair or efficiency by Oliver Wyman, we are right on time.
It's practice, I think.
Yeah.
Thank you.
So thank you very much, Ted. We will break for 10 minutes, and then Insurance Bureau of Canada will be presenting at 10:30 sharp. Bill Adams, Vice President, Western Province of the Northern Territories, and Ryan Stein of Director, Policy and Policy Development Division, I believe, are of the two presenters. So we'll break and see you at 10:30. Thanks. Back on schedule here, so we have IBC, Bill and, is it just Bill and Ryan are going to be presenting, so welcome, and I'll turn the floor right over to you right away so you can get into your presentation to the board.
Great.
Thanks.
Thank you, Mr. Chair, and good morning, everyone. Thank you for the opportunity to once again participate in the AIRB's annual review of auto insurance trends and rates for basic and additional coverage. As introduced, I'm Bill Adams. I'm the Regional Vice President for Insurance Bureau of Canada for the Western and Pacific region. And here to my right is Ryan Stein, IBC's Director of Policy. Dr. Ron Miller, who you heard referred to a number of times in the Oliver Weimer presentation, is IBC's Consulting Actuary. Dr. Miller is not with us here this morning, but he did assist in the analysis that forms the basis of our written submission and our presentation this morning. The focus of our submission and this morning's presentation is on three key areas. They are, first, the lost experience of the grid vehicle population. Secondly, BI claims trends. And third, the loss cost trend rates and other benchmarks that the AIRB uses when considering rating programs. And before I pass the baton, actually he already has the baton, but before I pass the microphone over to Ryan, I want to highlight for the board that the unusual cost trend for BI injury claims that we first discussed a number of years ago in this forum continues to be of utmost concern to insurers. We believe that we are at a point where the cost of these claims is at an unsustainable level given the average premium, and particularly when viewed in the context of the current economic conditions in the province. We are very concerned about the potential of increased premiums and the impact that they would have on Albertans at a time where they can least afford that. Ryan's going to get into the details in his presentation, so I'll pass the microphone over to him.
Thanks, Bill. This graph shows the market share of the grid population for the past 5 accident years, and the market share is based on car years earned exposure. You can see that because of the 5% and the 7% adjustments that the AIRB set during the annual reviews between 2012 and 2014, that the market share of the grid population declined by 1.5 percentage points. Overall, during this time period, the number of vehicles on the grid declined from 181,000 vehicles to 161,000 vehicles. We'll see the effect of the 7% adjustment that the AIRB set last year when the 2016 data is available. This graph shows the movement of loss costs for the grid population and the non-grid population. The dotted black line shows the movement for the total market. While the increases to the grid-based premiums in recent years and the decline in the market share of the grid population affected the cost trend of the grid population to a degree, this graph still helps us understand the differences between the two vehicle populations. Over the 5-year period, the loss costs for the grid population increased at a higher rate than for the non-grid population. Specifically, for the grid population, it increased by 32%, and for the non-grid population, it increased by 24%. Over the most recent 3-year period, the loss cost for the grid population increased at twice the rate as the non-grid population. For the grid population, it increased by 22%, and for the non-grid population, it increased by 11%. This graph shows the loss ratio for basic coverage. You can see that for both the grid population and the non-grid population, in recent years, the loss ratio has been well above the break-even point. For the grid population, the average loss ratio over the 5 years was 97%. For the non-grid population, it was 89%. You can also see that because of the different cost trend shown on the previous slide, the gap between the performance of the grid population and of the non-grid population widened. In 2011, the gap was 6 percentage points. In 2015, the gap was 13 percentage points. This graph shows the underwriting results, including operating expenses, for the entire grid population for basic coverage. Even though the size and market share of the grid population declined by a fair amount in recent years, the overall underwriting losses increased. Specifically, between 2012 and 2015, the annual underwriting loss increased by 31%, from $46 million to $60 million. We tracked the grid distribution data from GISA, which shows the number of vehicles for each grid step by accident year up to 2014. And between 2012 and 2014, for the most part, the proportion of grid vehicles for each step barely changed from year to year. Accordingly, we believe that the reason that the overall losses for the grid population increased so much is that the effect of the annual adjustments to the grid-based premiums, as bold as they are, was smaller than the effect of the annual increases in the cost of claims. This table shows the loss cost by subcoverage for the past 5 accident years. It also shows the annual change in the loss costs. Besides comprehensive, which fluctuates from year to year, the subcoverage that sustained the largest year after year of rising costs is bodily injury. The loss cost for bodily injury claims increased by 8% annually, which was 5 times faster than the rate of inflation. We examined the frequency rate and average claims cost to determine the cause of this development. During this time period, the frequency rate for bodily injury claims declined from 0.6 claims per 100 vehicles in 2011 to 0.55 in 2015. Accordingly, an increase in the average cost of a bodily injury claim was almost exclusively responsible for the increase in the loss cost. This graph shows the average cost of a bodily injury claim. Each year between 2011 and 2015, the average cost increased by at least 7%. Between 2014 and 2015, it increased by 14%, and overall, over this 5-year period, it increased by almost 50%. The study of closed bodily injury claims that IBC conducted last year helped identify the source of the cost trend. We found that in the sample of almost 2,500 closed claims, there's a subset of claimants with a minor physical injury who did not settle their claim pursuant to the cap on non-pecuniary damages that's prescribed in the minor injury regulation. All of these claimants had what we call an ancillary condition associated with their minor sprain or strain, which could be jaw pain, such as temporomandibular joint disorder, also known as TMD, anxiety, and/or pain symptoms. Because the cap did not apply in these claims, the amounts that the claimants received in their settlements is significantly higher than the amount that claimants with similar physical injuries received. While the size of the settlements is surprising, that these claimants with a minor physical injury and an ancillary condition did not settle their claim pursuant to the minor injury regulation is not surprising. That's because, as drafted in law, the cap does not apply to an injury that involves an ancillary condition, regardless of the severity of the total impairment. This graph shows the loss cost for total coverage for Alberta, Atlantic Canada, and Ontario for accident years 2011 and 2015. Largely because of the cost trend for bodily injury claims, total loss costs in Alberta increased at a faster rate than in the other provinces where private companies offer auto insurance. In 2011, the loss cost in Alberta was 34% higher than in Atlantic Canada. By 2015, the loss cost was 40% higher. In 2011, the loss cost in Alberta was 79% of the cost in Ontario. By 2015, the loss cost was 87% of the cost in Ontario. The cost of bodily injury claims, as Mr. Zubalake has mentioned, in Alberta is also expected to continue to increase at a higher rate than in other parts of the country. This graph shows the most recent future loss cost trend rates for bodily injury claims for the provinces across Canada that publish the trend factors, like the AIRB does here in Alberta. For Alberta, we included both Oliver Wyman's trend rate and Dr. Miller's trend rate. Regardless of which Alberta figure you use, the situation in this province is unusual and concerning. This graph shows the loss cost for bodily injury claims going back to accident year 1995 and projected to accident year 2018. The gray bars are the pre-reform years. You can see how fast and how high costs rose back then, which prompted the government to introduce significant reforms. The reforms were effective as of October 1st, 2004, which is why on the graph 2004 is shaded differently. The maroon bars are the years after the reforms, but before the sudden increase in the average cost of a bodily injury claim. And you can see 7 years of cost stability. The blue bars are the years after the sudden increase, which we discussed earlier. The blue line bars are Dr. Miller's loss cost projections. They illustrate that without amending the minor injury regulation so that the cap applies to all types of minor injuries that do not result in a serious impairment, the loss cost for bodily injury claims will continue to increase, reaching $422 in 2018, which is a level that has not been seen since the late 1990s and early 2000s. This table shows the loss cost by subcoverage for accident year 2015 based on the loss development factors that Oliver Wyman and Dr. Miller used respectively. The columns in maroon show the percentage changes over a 5-year period. Oliver Wyman and Dr. Miller's loss cost estimates are almost identical, and both of their estimates are similar to the estimates from Giza. Because for a few recent accident half years, Oliver Wyman removed certain data from some insurers and had discussions with those insurers, as Mr. Zubalake has mentioned, Dr. Miller cannot assess Oliver Wyman's methodology. Although Oliver Wyman's loss costs for bodily injury claims are similar to Dr. Miller's and Giza's estimates, Dr. Miller reports that if Oliver Wyman continues to rely on an analysis of confidential information in future reviews, the differences could become significant and could be pertinent to the board's work reviewing rating programs. This table shows the annual future loss cost trend rate by subcoverage from Oliver Wyman and Dr. Miller, and as Mr. Zubalake pointed out, they're quite similar, although there are some small differences, and the difference for bodily injury claims could be because of the different type of analysis that Oliver Wyman did this year. These pie charts show the claims experience between the two most recent 5-year periods in Giza's catastrophe report for the province of Alberta. You can see on the pie chart on the left that between 2010 and 2014, there were a lot more claims from natural catastrophes than there were between 2005 and 2009. Specifically, between 2005 and 2009, the 27 events caused under 46,000 claims. Between 2010 and 2014, the 33 events caused almost 128,000 claims. The pie chart on the right shows that between 2010 and 2014, the overall cost of natural catastrophes were a lot higher than between 2005 and 2009. Specifically, between 2005 and 2009, the annual cost was $38 million with an average claims cost of just over $4,000. The most expensive year was in 2007, with $61 million in losses, which at the time was the most expensive year on record. Between 2010 and 2014, the annual cost was $143 million, with an average claims cost of $5,600. During this 5-year period, there were 4 years where there were more than $100 million in losses from natural catastrophes. There were $188 million in losses in 2010, $171 million in 2012, $132 million in 2013, and $178 million in 2014. Giza may not release the 2015 catastrophe loss figures until the fall. Nevertheless, the estimated losses from the 3 major summer storms that year indicate that 2015 is another year of high catastrophe losses. And as Mr. Zubalek pointed out, because of the wildfire in Fort McMurray, 2016 will probably have the highest insured vehicle damage losses from natural catastrophes in Canadian history. Because of the increases in losses from natural catastrophes in recent years, Dr. Miller continues to advise using a provision based on the weighted average of the past 5 most recent years, which is 65%, instead of Oliver Wyman's approach of using an average of the weighted average factors for the past 5 and 10 accident years, which is 55%. I'll now turn it back to Bill.
Thank you, Ryan. And in summary, we want to leave the board with the following messages on behalf of the industry. First, that this year's adjustment to the grid-based premiums should account for the cost trend for the grid population and the huge losses that have accumulated in recent years. Otherwise, we believe the difference between premiums set in the competitive market and the premiums set according to the grid will decline, and that the market share of the grid population will once again increase. Second, without action to fix the minor injury regulation, the cost of BI claims costs will continue to rise at a much higher rate than inflation and put more pressure on the premiums that all consumers have to pay. Third, insurers may file rating programs using reasonable trend rates and assumptions that may differ from Oliver Wyman's selected rates and assumptions. And fourth, finally, changing climate patterns support using a comprehensive catastrophe provision based on 5 years of loss experience. With this, we've reached the end of our presentation. I'd like to again thank you for the opportunity to present the views of the industry, and we'd be pleased to respond to any questions.
Thank you, Bill and Ryan. Any questions from the board?
Yeah, I have one. Maybe can we just talk a little bit about the grid population? Thanks so much for your presentation. You mentioned that you feel the grid requires a significant increase. Do you believe that the grid should be self-supporting and that it, hits the 7% property provision, or?
Well, I think it's the grid is a public policy instrument, and so I believe that it's there to provide a ceiling price for auto insurance. So in that case, whatever profit, if any, is really up to the board and based on the government's design. We struggle a little bit with what's the ideal market share and what's the ideal premium. It's right now at 6%, which is quite good, given where it had been only a few years ago because of some big decisions that the board has made. I don't know if this is what, is this the market share that the board wants or that the government first wanted when it designed it? There's no kind of benchmark of where it should be. But we're in an environment right now where costs are increasing at quite a high rate, and they've been increasing at that rate for a number of years. So just based on that, and just to, we believe that the market share should come down a bit, but, even to get there, you've seen that even some of the bold decisions that you've made have only, reduced it by, a few points at a time, so.
Bill had mentioned, the balance between trying to increase premiums in tough economic times. So how do you balance? Like, what is the increase that you would put through on the grid to balance, not driving people to start driving again without insurance? Any advice there?
Again, it's a public policy decision. Fundamentally, we believe as an industry that riskier drivers should pay more. So there is, you need to consider that as well. But, we really have no position because, again, the view is that it's a public policy instrument to accomplish objectives that are deemed good for those particular drivers. So we can't really
Well,
provide
thanks for
any.
nothing. No.
Pardon me? We understand.
Yeah, it's
We
a
understand the
dilemma,
challenge. I mean,
right?
it's a great point of discussion, and the grid was brought in for a particular reason. We believe that it's accomplished that reason, but I think it's you also need to sort of pull back and recognize that unless the premiums continue to reflect the experience and the cost, ultimately those costs are borne by other
Right.
drivers.
But you're not suggesting that the grid be self-supporting without subsidization from the regular market?
We're not saying that.
I don't think
Okay.
we go that far, no.
Yeah, okay. Thank you.
Just follow up that, I know a significant increase may be a relative term, but, are we talking significant be 1% or significant 10%? Is there a flavor that IBC can provide the board as to how much of an increase, even though, or a range?
Well, I think if the last few years have justified 7%, then this year, for sure, I think the trends are continuing, if not bigger than they were before. So, 7%'s a base, if that's what the cost experience calls for.
Right. Thank you. Maureen?
I have 2 questions. So as an industry, do you know what % of those insured make BI claims?
Off the top of my head, I can't do the percentage. I know that there's about 2.7 million insured vehicles in the province of Alberta, and there's about 14,000 BI claims.
Okay. And is that, it would be helpful to know what those numbers are for maybe the last 5 years. So I don't know if we can.
We can pull that for you,
Okay,
no
that's
problem.
great.
We'll follow up.
And then a second one, again, as an industry, with respect to the safety improvements in vehicles, are there any trends or any predictions from an industry that, as you start to see cars being made safer, when we might start to see improvements as far as the trends go around bodily injury?
Oh, can bring in a number of consultants and hear like a whole bunch of different answers. I mean, for everything from there's going to be automated vehicles on the road in, 40 years and there's not going to be accidents.
Yeah.
It's hard to say. I would anticipate, the continued type of incremental changes you see to vehicle safety that we've been seeing for a while, and see that to continue.
Have you seen improvements in the trends with the incremental improvements?
Just, it's hard to correlate,
Sure.
Without knowing all the details. But, the frequency, to the first part of your question, the frequency rate of bodily injury claims had been,
It's coming down.
it's coming down, and it might be bottoming out and, slowly decreasing a little bit from year to year. I'd call it stable.
Okay. Thank you.
Chris, you have some questions?
Yes, I have 2 questions. Going back to the same graph that Maureen was referring to, you basically correlated between 2003 and 2017 projections, 2018, are sort of a similar level. If we cast our mind back to the 2003 levels, we were in a period of high competition. We were in a period of fairly competitive rates, or very competitive rates. We were in a period of companies not reacting to the losses that were being experienced in those days. However, still, excuse the expression, still going after market share and ignoring all the signs. We are not seeing, as a board, we are not seeing companies lining up to come in at 15 or 20% or whatever the figure is for increases. So what does it take to suggest that the companies start to react to what I would call a more responsible level of increases?
I think within the context of the competition law, I'll try and be careful. It is still a highly competitive market, and I think what you're seeing in the current environment is that competitive forces are having that very strong hand in terms of any premium increases that might otherwise be warranted. I also think that in speaking with individual insurers, there is a very high awareness of the sensitivity around the economic conditions in the province, and that the impact that any particularly significant auto insurance premiums would have, increases would have on Albertans. This in the broader context of having seen what's happened with home insurance premiums in recent years, the result of ongoing challenges with severe weather, et cetera. So I think it's fair to say that most Albertans have seen their home insurance rates go up a reasonable, if not a substantial amount. So there is a view generally by insurers that any significant increases on the auto side, particularly now, would provide both a lot of grief for Albertans and potentially a backlash, if you will, a public backlash, which I think individual insurers would not want, and certainly as their trade association, we would prefer to avoid. The uncertainty that I think many are considering as they file those rates, and you can speak to those that will appear later about this, is that we hope that the case that we're making for changes to the minor injury regulation and the changes to the regulatory environment are ones that are going to be considered by government and acted on by government to control those claims costs and bring a little more stability and predictability back to the claims environment that will potentially avoid what otherwise might take place.
Okay, thank you, Bill. The second point, as I brought up earlier with Ted regarding theft. Do you want me to repeat the question, or are you?
Sure, no, go ahead, and I'm going to check because I emailed a colleague to see if I could get some information.
Okay. So the question basically related to, we've seen 2014, 2015, a rise in theft claims exponentially beyond what could normally be anticipated. At the same time, in 2016, a recent article in the Thomsons suggested that crime rings had been significantly broken in Alberta. And did this have any impact on the current statistics or future statistics? Easy for me to say.
It's historically we've seen in jurisdictions across Canada that there is a direct correlation between an economic downturn and an uptick in stolen vehicles and in other fraudulent activity related to the insurance industry. So what we've seen in the last year or so in Alberta is, I don't think is a surprise to anyone in the industry. It might have been predicted. What we have not yet, thankfully, seen is the emergence of sophisticated criminal rings that are most prevalent in Ontario and Quebec, who use the richness of the auto insurance system to create scenarios where crashes occur, where they organize themselves for mass theft of vehicles and sophisticated distribution systems, usually outside of the country, or chopping those vehicles into parts as part of the black market activity. One regulator once, official from law enforcement once talked about these types of criminal rings as a bit of a whack-a-mole. In one jurisdiction, when you get tough with them, you whack them, they eventually reappear. In another jurisdiction that have the conditions ripe for a profitable venture. We are concerned that to the degree that Ontario specifically has, in the last couple of years, gotten much tougher with these criminal rings, that there could be an emergence in Alberta they may surface here. We've not yet seen significant evidence of that. We have seen a couple of instances where there was clearly criminal ring activity taking place, but no long-term trends. So we are working with law enforcement. We're working with other officials to monitor that, organize ourselves in such a way by creating, for example, an organization called PATNet. It's a provincial auto theft network that was endorsed unanimously by the Alberta Association of Chiefs of Police. And it provides essentially a network of between municipal and provincial law enforcement entities for the sharing of information related to fraudulent activity and theft, with the intent of being as sophisticated, frankly, as sometimes as the criminals are, and leading to both a deterrent and to a higher conviction rate. So there's a number of things that we're doing, and we're working with law enforcement to make certain that we, to the degree that we can, we are creating an environment that is not welcoming to those elements. And if and when we do see it occur, we're organizing ourselves more efficiently to seek out and to ensure that prosecutions occur.
Okay, on that topic, if I could just add, Kinetics, is that the?
Kinetics, C-A-N-A-T-I-C-S.
Kinetics, the organization that was established in Ontario as a sharing of information regarding suspect claims, if I can use that expression. That is a recent addition, if I remember rightly, last year, the end of last year. Is that up and running, and is that having any significant impact on bringing to justice those areas?
Yes, is the short answer. So Kinetics is an entity that anonymizes but pools all of the claims data from the insurance industry and uses sophisticated algorithms to mine that data for anomalies that often signal criminal activity, fraudulent activity, and launch investigations with appropriate law enforcement authorities to seek out and to prosecute. It has had tremendous amount of success in the eastern part of Canada, and I'm happy to say that it is now active also in Western Canada, and be happy to suggest to their CEO that perhaps a presentation to this board might be appropriate, so you understand the sophistication that they bring to seeking out and prosecuting criminal activity.
Okay, thank you.
Any other questions from staff? Or, oh, sorry, go ahead, Jamie.
Thanks. So the cap's been in for 12 years, gentlemen, and until last year we heard about the Sparrowhawk decision, which set out TMJs not being covered under the minor injury regulation. And in the last year we had the McLean case where an individual who was injured for a 4-year duration was found not to have a minor injury. Maybe I'm looking at the other side of the coin, or for sure I am, but it would seem to me that with those two decisions, that the clarity and the certainty and the predictability that you're seeking has been established. And that, to me, doesn't necessarily mean that the increases would continue. I would expect that if you have predictability and you have settled case law, that then you would have more consistency and you'd be able to accurately reserve better. My question is whether that's built into any of the assumptions, or whether you're just whether the graph going up is just indicated to go up on that basis.
I mean, you'd have to ask each actuary individually how they came up with those numbers. But if you look at, the similarities between what Dr. Miller said and what Mr. Zubalake says compared to the numbers from 2011 to 2015 that Giza puts out, which are done by Ernst & Young, I think it's pretty clear that the costs are continuing to increase. Will they continue to increase at 7% every year past, 2018? I don't know. I mean, it makes sense that eventually everything kind of settles down, but it's looking like it's going to settle down at an extremely high number.
The other comment or question, I guess, is we've heard from Oliver Wyman and we've heard from you fellas, and we'll hear more later on about the increase in payouts. I haven't seen any reflection on increases in revenue with more vehicles being on the road every year and with premiums actually rising. Do you have a sense of revenue increases over the last 5 years on an industry-wide basis?
I mean, the loss, I mean, we know what the average written premiums are. We know what the total number of premiums are. I mean, the loss ratio over the last few years has been hovering around 80%, which is quite high. So, the industry's results have sort of seemed to be at that level, which is not quite sustainable in the long term.
Okay, but we don't know how much actual revenues are increasing every year, but we do know, or nobody's presented to us how much premium revenues have increased over the last 12 years. But we do know how much payouts have first dipped, then stabilized, and more recently increased. Is that fair? I'm just curious as to, we have a numerator, but we don't have a denominator.
I mean, we can give you those numbers. We were showing the loss ratios.
Yeah, I
at that
understand
level,
the loss
so,
ratios. I'm just trying to put if you put the payouts out on their own, I think it would be more appropriate to our group. This seems like still a very strong jurisdiction to write auto insurance, and the requests we get for rate increases, as was set out earlier, are not congruent with the figures and predictions that we're hearing. And I'm just trying to resolve the disconnect there. So I think the revenue numbers would help in looking at that. So if you could do that, that'd be great.
We could certainly
Fine.
provide those, and none of us know what the future holds, but we can all look at different experiences, both in this market and in other jurisdictions, some of which different circumstances, but to see an environment where there is a multiple year building of cost pressures and not a corresponding response by insurers to apply for actuarially justified premiums we've seen this story before. What we've also seen is that when you get to the end of that story, when those pressures build to the point that competitive forces and the prospect of changes to the regulatory environment are no longer sufficient to stifle what otherwise might be applied for, those premiums come very quickly and significant double digits. And that's the shock to Albertans that we are attempting to avoid.
Alberta has moved away from its, industry-wide rate to file and approve. And again, the concern that the board has is that the industry has the ability in Alberta to seek increases to offset those increased expenses, and we want to avoid for the paying public any sticker shock or price shocks. So, where there is a need for minor increases, we would, I think the consensus of the board is that we would like to see those as opposed to it building up and all of a sudden a big, large increase, which will not be good for the industry, not be good for the public. So Is that
We certainly share those views as a trade association, and but given our role and the limitations of our role, hope that individual insurers are listening loud and clearly.
Last one, guys. Everyone's laughing. So the one thing that hasn't been brought up, and I don't know if you have anything offhand that you can share on this, but over the last 5 years, the prevalence of policies with limits of over $1 million, whether it be a 2 or a 5 or some sort of an umbrella, on the stats we've got has been increasing by about 10% a year. So it's now around 12% of policies in this jurisdiction are over $1 million. Is that taken into account in any way on the increase in payouts? I think it's obvious that you're going to pay more for $2 million in insurance than you're going to pay for $1 million, and I do personally. But is that taken into account? Because it would seem to me again that there would be a bubble effect there, even if you had 50 claims a year that suddenly were the massive catastrophic exposures and a lot more limits available.
We'd have to go back through our study, see how many settled at those high numbers. From our, I mean, people will buy higher limits to, protect their assets and all that kind of thing. The claims that we think are causing, are the source of the cost trend, they're not settling in the $1 million category. They're settling in the tens of thousands of dollars, $50,000, $60,000 range.
Okay.
All right. Any comments from our board's advisors or staff? No? Okay. All right. Well, thank you, Bill. Thank you, Ryan.
Thank you.
We do appreciate your presentation. And without ado, I think we'll move right on to agenda item 4, which is Facility Association. We are slightly ahead of schedule in the event that we'll see how the FA presentation goes and the time needed. But Chris, if you have no objections, if we have time before lunch, if you could be prepared to make your presentation, we'd appreciate it. Yeah, okay, sure. We'll talk about that later. All right. So we have David Simpson, President and CEO, and Sean Dorothy, Senior Vice President and Actuary and CFO of Facility Association. Thank you for joining us. Again, we always look forward to your presentations each and every year.
Thank you, Mr. Chairman. It's a pleasure to be here, and we welcome the opportunity to participate. And would like to be, before I get into my prepared remarks or our prepared remarks, I would like to say that we do appreciate the open and transparent nature with which this board conducts its business. We serve 9 jurisdictions. Some are a little bit less open, I'll put it that way, and we do truly appreciate that. And in a similar spirit, I want to acknowledge the comments from Mr. Zubelik in terms of Sean's input and from his team into the actuarial process. Not all jurisdictions invite input, but those that do, I encourage Sean and his team to participate in a good faith and open way. One of my mentors had kind of a corny saying that said, none of us are as smart as all of us, so to the extent that we can share learnings and move the process forward, we're pleased to be a part of that, and we appreciate that opportunity as well. So on to the formal part of the presentation, if you will. I am Dave Simpson, the President and CEO at Facility Association. With me today is Sean Doherty, and he's our Senior Vice President Actuarial and CFO. And Sean is a fellow of the Canadian Institute of Actuaries and a fellow of the Casualty Actuarial Society. We're here today primarily to provide our usual annual update on the Alberta risk-sharing pools, their size and financial performance. And our presentation this morning is by way largely of an annual update. We do like to take a templated approach for those that are interested in looking back and see how things are moving through time. We think that's the easiest way to move through the process. And we will try to be relatively brief. I didn't take that comment, Mr. Chairman, as a challenge to allow time for Chris, but
Take all the time you need within the time you have allotted.
thank you, Mr. Chairman. I appreciate the guidance. Our mission and vision are on the next slide. And the key part of our mission that we focus on is that we always want the market share of residual markets to be as small as possible. And that's so consumers can benefit as much as possible from the competitive market. And our vision, we want to be recognized and relied upon as efficient and effective administrators of residual markets. And we also want to be relied upon for objective viewpoints when we're asked by any stakeholder about residual markets. Just a quick summary. Most of the faces in the room are pretty familiar. You've seen this before, so I'll go through it very quickly. In Alberta, we operate two residual market mechanisms, the residual market segment for all types of vehicles, the risk-sharing pools for private passenger vehicles only. The residual market segment is all types of vehicles. They're written at residual market rates as approved by this board. And all intermediaries in the province have access to participate in the residual market segment. And any consumer approaching an intermediary with a residual market segment qualifying risk will find that the rates and the rules are the same regardless of which intermediary they approach. So the consumer has full choice if they do have a residual market risk and which intermediary they choose to deal with. The other type of mechanism that we operate are risk-sharing pools, and that's the focus of our presentation today. And they are for private passenger vehicles, cars, minivans, light trucks as defined in the automobile stat plan only. The important distinction between the residual market segment and the risk-sharing pools is that the risk-sharing pool risks are written at individual company rates. Companies then make the decision subject to eligibility requirements, which are posted on our website, as to what they will cede to the two risk-sharing pools in the province. And all that happens behind the scenes, so that the operation of the risk-sharing pools, while meaningful presumably to the companies, is invisible to the consumer. It acts very much like a industry-funded reinsurance mechanism from a consumer perspective. We administer sharing mechanisms, whether it's the residual market segment or the risk-sharing pools. At the end of the day, they are sharing mechanisms. And the balances of both the residual market segment and the risk-sharing pools are shared amongst Alberta insurers. They're not dispersed throughout the other 8 jurisdictions that we serve. And I use the word balances or amounts carefully rather than results when I talk about sharing, because we share not only the bottom line results with our member companies, but the top line as well. We share the premiums with them. And on those top line amounts, they must pay such things as premium taxes, health levies, just as if they'd produced that business that we assign to them based on, broadly speaking, their market share, just as if they'd produced that business through their own efforts. From a governance standpoint, our method of operation is authorized by our plan of operation as authorized by the Superintendent of Insurance for Alberta. It's available to anybody that's interested on our website, and we always welcome questions from this board, from other interested stakeholders about the residual markets, how we operate, things of that nature. If you'll allow the comment, Mr. Chairman, we're usually more ready to talk about residual markets than there are people asking questions about it. So we're always available for those that are interested. On a more serious note, we do share a significant amount of information on a monthly basis with this board and its staff and with the superintendent's office. And we believe that it's important for all the key stakeholders in the marketplace to have that access to information about residual markets and how they're behaving as an indicator of the overall health of the market. Bill Adams referenced the Competition Act. We are the market of last resort. Sometimes we're referred to that. We're not in competition with anybody, so we're very open about the information that we share because we believe that's in the best interest of a healthy marketplace. Before I get into the size of the risk-sharing pools, in general, we observe throughout North America and every jurisdiction in Canada, every state in the United States has its own approach to regulating rates. In general, we see that to the extent that more competition is allowed, that's associated from a price standpoint, that's associated with smaller residual market mechanisms, and that's aligned with our mission. So generally, we support price competition. All other things being equal, we would expect the move of the last couple of years away from the industry-wide adjustment to an individual file and approve system for rates to lead eventually to smaller residual market mechanisms. But as always, not everything is always equal, and we'll see a little bit more about that in a moment. So for Alberta, we administer 2 risk-sharing pools. The grid pool, pretty obvious, that's for risks that are capped by the premium grid. There is no transfer limit if subject to other eligibility rules, but broadly speaking, if a grid risk or a risk is rated at the grid, then it can be transferred to the grid pool, and there is no numerical limit on the number of risks that a company or the industry as a whole can transfer. There is a limit implied by the fact that there's a limit on the number of grid risks in the marketplace, of course. For the non-grid pool, there is a limit, and we administer a risk-sharing pool in Ontario, sometimes referred to as a gray risk pool. The non-grid pool serves a similar function, and that's for risks that companies are required by law in the province to take on in their books through the take-all-comers requirement, that they believe when they look at the risk when it comes in the door, they look at their rates and rules matrix and believe that risk to be underpriced. They have the non-grid pool as sort of a relief valve, if you will, and they can transfer up to 4% of the risk not transferred to the grid risk-sharing pool to the non-grid pool. The next slide here shows the size of the risk-sharing pools on a written premium basis for the last 5 years. And we're pleased to see that aligned with our mission, the pool combined total shrank from 7.8% of premium to 7%. And the decline has been most noticeable, as you can see from the slide, in the grid pool, and that is likely due to, as IBC noted, the decline in the overall grid population. You see less movement in the non-grid RSP in terms of the market share. The next slide is the market share based on written exposure counts. And again, we can see a decline there from 4.9% in 2014 to 4.4% of written exposures in 2015 for both pools combined. And again, most of the decline you see is in the grid risk sharing pool. I mentioned in my introductory remarks that our presentation today is largely by way of our usual annual update. So we're departing on this slide a little bit from our usual annual update because we provide our members, and it's freely available on our website, with an outlook of what we think the volumes will be for various residual market mechanisms that we administer for 2016, 2017. That was posted to our website a few weeks ago. And that outlook is based largely on the projections that our companies provide to us, gathered by Sean and his team, as well as their own work. And what we'd like to point out is that our current expectation is that we'll see a relatively large increase in exposures transferred to the non-grid risk sharing pool through year-end 2016, through the end of this year, and another relatively large increase in transfers to the grid risk sharing pool in 2017. So to the extent that member companies transfer business to risk sharing pools that they believe to be underpriced, this would suggest to us that there are likely cost pressures in the marketplace that companies are being challenged to deal with. And I mentioned all other things being equal. This is a case where not all other things are equal. And I'd also mention that, and we'll see it a little bit in the behavior of sessions to the pool in a minute, that we use industry as kind of a shorthand. And it's a convenient shorthand, but of course an industry obviously is made up of individual companies making individual choices at points in time. So these are projections. This is the company's view at the point in time. Our experience has shown that what companies actually transfer to the pools can change quite significantly. Their reality changes, their plan changes, whatever, things do change. But this is the view that we have right now, and because it does seem to exhibit a little bit of pressure within the industry, we wanted to take the opportunity to share it with the board at this point in time, rather than come back next year and talk about it just simply in retrospect. And there is more detail on how these projections were derived in our outlook on our website. So returning back to year 2015 in review, I talked about the industry as a monolith, but here we see how individual companies have approached their transfers to the pool, and the grid pool is on the left, the non-grid pool is on the right, and so the ones on the left of each chart where you see the bar going below the line, we refer to those as decliners, companies that decline their transfers to the pools, and the ones on the right are the growers. And you'll see in the grid pool, there was a substantial grower there in 2015. Most were actually withdrawing risk from the grid pool. In the non-grid pool, we see more of a mix there. And that kind of mix is what we would expect to see, what we'd like to see in a competitive market as individual companies make their decisions in the marketplace. We'd see it's pretty normal for us to see companies changing their view of how they need to use a risk-sharing pool from year to year. Some companies will increase, some will decrease, and then the next year they'll switch places. It's always moving around. Where we would become concerned is that if everything moves to the right, and if everything, in other words, if companies throughout the industry started increasing their transfers to the pool, that would indicate to us that there's pressures manifesting themselves in terms of loss costs outstripping premium growth. In terms of context, pleased to note that the Alberta residual market size for private passenger vehicles has declined significantly over the last few years. That said, it's the fourth highest in North America on an exposure count market share basis. When we look south of the border, there's well over 40 of the 50 states have less than 1% of their vehicles insured through the residual market for private passenger. And the last time I looked, there were 35, 36 where there were less than 1,000 cars in 35 or 36 states, private passenger vehicles insured through the residual market mechanism. Moving to the loss performance of the pools, this gives you the history of the loss ratio as Sean and his team see it, or more appropriately, really, it's our appointed actuary, who's Liam McFarlane of Ernst & Young. He's got the final say on our loss ratios and the numbers that underlie our financial statements. And it shows a little bit of the volatility that the loss ratios of risk-sharing pools can be subject to. Actuarial work is challenging in and of itself, but when you're talking about a pooling mechanism where, unlike a company where the book of business should be relatively consistent one year to the next, in a risk-sharing pool, that's not necessarily the case. As I mentioned earlier, companies transferring risks in, some are pulling risks out. Sean and his team have to figure out, is that mix of business changed, or does it look different from what it did last year? So you see a lot more volatility in the actual business itself, and that's reflected in the loss ratios, and it does go to the challenge of pinning down that number earlier on. My challenge is always to Sean is better estimates faster, please, and he and his team continue to work on that. Moving to the next slide, this breaks down those numbers a little bit in a way that similar to the slides we saw from Mr. Zubalake, where the loss ratios have been segmented into the paid, which is the blue, the case reserves, the red part of the bar, and the IBNR is the green part of the bar, which would be analogous to Mr. Zubalake's terminology of actuarial reserve. And it gives you a sense of overall the grid pool accident year ratios are moving up compared to what we've seen, and they tend to fluctuate between 60 and 80%. This is a snapshot at our last fiscal year end, so October 31st, 2015. For those that are interested in more recent numbers, we update these monthly on the actuarial highlights that we post to our website, so if they're of interest to see how things are moving, they're always available there. And Mr. Chairman, I hope you'll indulge the comment, but we have teenagers at home, and if you want to get a laugh from that demographic, put actuarial and highlights together in the same phrase. It's pretty, almost always a surefire winner. So I don't mention that at the dinner table anymore. In contrast to the grid pool, the non-grid pool's loss ratios are both generally at a higher level and a wider range, so we see more volatility here as companies do change their stance to the pool, so we see a range of 85 to 105%. And it also tells us that generally the actuaries and the underwriters, when they're doing the risk assessment, they know what they're looking at. They know when they've got an underpriced risk, and they know when they need to use the non-grid risk-sharing pool. In terms of financial performance, as shown in our audited financial statements, the grid pool is showing an accumulated surplus since inception of $62 million. The non-grid pool is showing an accumulated deficit of $245 million for a combined deficit over the years of $183 million. And 2005 says 13 months there because we actually launched both pools in late 2004. It's important to note that per accounting standards, those numbers I just showed you only happen within our own, or the numbers that reflect the activities that happen within our own operation. The impact on companies is a little bit different because they have to include, remember the impacts you see on the slide here, health levies, premium taxes, income taxes, cost of capital, and investment income. So none of those elements are included in the numbers on the previous slide. Potential market consequences, we're all thinking in terms these days of enterprise risk management. When we think about the risk that pools can mean to a marketplace, and we recognize them as a valid and useful residual market mechanism, insurers are dealing with 7% of their premium volume over which they have little or no control. And our concern was, or always is, and why we want our market share to be as small as possible, is that companies might change their stance relative to approaching the Alberta market because of their exposure to the results, the balances, the sharing they must participate in from the residual market segment, and that's or segment and the risk sharing pools. That's why we want risk sharing pools and residual markets to be as small as possible. So companies looking at approaching the Alberta consumer with a competitive offering and getting out there in the competitive market aren't holding themselves back by saying, well, I'd love to do business in that marketplace. I think I've got a great offering for the consumer, but I'm nervous about what I might get back from the residual market mechanisms. And that's why we want our market share to be as small as possible, because we do want choice to be maximized for the consumer. Market consequences, if pools are not financially self-sufficient, as the proverb has it, where there's no profit, the loss is obvious. And so, again, next slide there, please, Sean. We talked about, the grid is set as a public policy initiative, but it's just a reminder that the costs have to be borne by someone, and at the end of the day, it's the consumer, and just a matter of which consumer group of consumers pay, and that level of subsidy is worth thinking about. Also, and it gets back to my earlier theme about industry not being monolithic, that when we talk about the risk-sharing pool impacts, because of the sharing nature of the pool, how companies are interacting with the pool, their results relative to the pool are going to be different from each other, and we would encourage the board to be cognizant of company differences when companies are approaching them for those individually approved rate filings. And as always, we want our risk-sharing pool, residual market segment to be as small as possible, because it mitigates the potential volatility impacts, and we want to promote market stability aligned with our mission and vision. Also, we think there's an opportunity for fewer risks to be eligible for the grid. I mean, we're seeing that population decline over the last few years. There's the ongoing consultation process, which is being currently led by the superintendent, and we're sure our industry will have a few comments on how things might be changed a little bit in the premium regulation to make sure that the grid is in fact targeting that group of consumers from a public policy standpoint that you want to protect. Adequate grid rates, subject to the public policy conversation that was had a few minutes earlier. And we also think there's room for increased competition below the grid, and we have seen, of course, a very significant step towards that increased competition through the file and approve individual company rate approval mechanism. And that concludes our prepared remarks, Mr. Chairman. Be pleased, to, as always, to take any questions from the board. Thanks again for allowing us to be here today.
Well, thank you very much. I'd like to open the floor up for a conversation on the board. Yeah.
Sean, on slide 12 there, you showed projected significant increase in the number of risks in the non-grid and the grid. Are you already seeing that in this first half of 2016 and then sort of trending from there?
Yes, we are, in fact. In particular, in going off the top of my head, the results most recent results that we saw for the non-grid in particular had a significant increase for the first half of 2016. We are seeing increases for the grid as well. Interestingly, we're not seeing the increases for the farm. So the business isn't coming into the farm segment. That continues to decrease substantially. It's been increasing over 30% per year. So those risks have been decreasing. But yes, we are already seeing this pickup. Our members, we ask for projections from significant users of the pools. We don't ask for projections from everybody. The projections we were getting early on changed significantly at the beginning of this year. And so already in March and April, we were getting increased projections from our membership that they were intending to be using the pools more heavily, and we are seeing that pick up.
So it almost appears to me, and you correct me on this, that companies, rather than taking perhaps their indications on the rates, are starting to put more stuff into the pools that they deem underpriced rather than pricing it correctly?
That's certainly a possible hypothesis. We don't ask member companies for the rationale for their projections. We simply ask them for their projections. So we're not privy to what actually drives their decision-making behaviors, but I would suspect that might be something that they're considering.
Thank you.
And perhaps if I could just make a couple of comments on some of the questions that were asked of IBC. Two in particular that struck me as interesting. The first was on limit increases over time. I think you may have been an actuary in a previous life and that you're trying to get that back. Through the process of rate reviews, one of the considerations that actuaries take into account is that claims trends will reflect over time changes in risk characteristics. And to the extent that insureds are purchasing different levels of insurance, particularly higher limits or different deductibles, premium will be impacted by those changes, but you will also be seeing those changes through the claims. So in the case of increasing limits, obviously that would have a potential impact on increasing severity. So to make sure that we do matching from an actuarial perspective, if you're showing an increase in severity and you're expecting that increase in severity to continue, you need to look at how much of that is being caused by what we would call drift in the purchase of limits or higher limits. And so we take that into account through a premium drift adjustment, through looking at historical views of limits over time, and so we try to take that into account. Other types of drift calculations that we look at for premium changes would be related to deductible changes on physical damage, also driving and driver record and classification changes in the population over time. So we try to take those things into account to make sure that we're not just saying claims are increasing but not reflecting the reality that for some of it, premium would also increase through the mechanism of the rate classification system itself. The second interesting one was on the more certainty because of judgments that came out. And I made a note to go back and look at that a little more closely because I think it's something that we haven't fully thought about ourselves. I think the interesting part for me, if we think about the uncertainty, is both from the perspective of the insurer themselves, but also from the claimant's behavior side. Because if I'm a claimant and I have uncertainty about whether or not to proceed with a claim because I'm not sure how the insurers or how a judgment will react, I may take into account that uncertainty and decide whether or not to make the claim. Now, if there is more certainty, perhaps from an insurer's standpoint, I'll have a better idea of where I think the ultimate costs are going to be early on. But it also might be influencing claimant behavior itself. to the extent that, whereas before they might not bring forward a claim because they were uncertain of the outcome, if they're more certain, they may now bring the claim. With respect to the trend itself, I think it's a good point that the 7% may reflect both what's been happening over the recent time of increasing, and if something can't increase forever, it will eventually stop increasing. The question I think I will be going back and challenging my team with is, do we think that with this level of certainty, is it going to plateau, and to what extent and when will it plateau, and what will that trend rate drop down to? I think the concern I have about the claimant behavior is that for a certain period of time, you'll have increases related to claimant behaviors now coming forward on something that's more certain. So as Ryan had pointed out, at least to maybe 2018, you might continue to see that severity trend keep going up, because you're going to have, even though perhaps because cars are becoming more safer, as was suggested earlier, so that would tend to push frequency down. Maybe frequencies being offset a little bit because you have claimants who wouldn't bother bringing forward a claim now think because of this certainty it's worthwhile, because they have a better idea of what they're going to get and how much it's going to cost for them to get that through the legal process.
Thanks.
Mr. Ashford?
Yeah, there you go. Get a new card.
Yeah.
I have a question. Can FA provide advice to the board as to what grid pool market share we should be considering as an acceptable level, given that we're currently at 4.4%, and what rate increase, if any, that the board should consider for the grid for this coming year?
Well, in our mission statement, Mr. Chairman, we use the phrase as small as possible, advisedly, so we don't have a number in mind for you. I apologize for that, but we don't have a number in mind. I think it comes back very sincerely to the earlier discussion around what the public policy objectives are, who should be protected in terms of drivers, what group of drivers should be protected by the grid, and then companies will make their choices as to how they view the grid premium as adequate or inadequate, and transfer business to the pool according to their judgments. So in terms of the overall size of the pool, we think smaller is better, but we recognize that Alberta has taken a public policy stance for well over a decade now, and that's the environment that we all work within. So it's not for us to say really who the grid should protect. We believe that's for the policymakers, and our trade association might weigh in a little bit more than we do. Our focus is more on administering, sticking to our knitting and focusing on the administering of the residual market mechanisms that we're charged with administering. In terms of a specific number of rate increase, I don't think that we did that analysis, Sean.
We didn't, but we would just point to the loss ratio chart. And I think it was kind of alluded to with IBC with respect to the public policy on how many or who are to be protected, and then the level of protection. I think you can look to the loss ratios and put in some sort of loading for expenses to get an idea of what is the extent that these risks that you deem need to be protected or subsidized to some extent, what that level of subsidy should be. And I think that two things I would take away from this chart or suggest from this chart. One is that it does look cyclical, and this is like the industry. So you could put an industry view on here. It would have that same sort of cyclicality. It just wouldn't have the same level, but you would see the same sort of shape. So I think you need to look at over a business cycle. I wouldn't look at any one particular year. An underwriting cycle, maybe it's about 7 or 8 years to look at, but have an idea in mind about what that target loss ratio should look like. So you have an idea of what you're expecting or what you're targeting for your subsidization, and then set the rates according to that.
Ted, you have a question?
On this chart you have there, do you read anything into the fact that the 2015 estimated loss ratio is now lower than 2014, kind of breaking the increase, the pattern of increase?
Yeah, it's always interesting to look at the most recent year. I would actually suggest that if you look at 2013 and 15 and take a look at 2014 with that respect, we think that 2014 is actually the anomaly as opposed to 2015. I think that 2015 is more in line with what we were seeing from 2013. 12, 13, and 15 are more aligned. I think that 2014 is a bit of an anomaly. We see the same anomaly here in the non-grid, where you can see the 2014 jumps out. If I remember correctly, we had some pretty severe weather in 2014 that created a bit of a change in our view for 2014 early in 2015. So I think that's more what we're seeing as opposed to 2015 being the anomaly.
And I noticed along the same lines that from another chart, you have that the initial estimate, last year's estimate for 2014 was only about a 70% loss ratio. There it is. And now it's closer to 80.
Yeah, and this was the first quarter of 2015. We saw a large number of physical damage claims came in that we weren't expecting to see, and that really it surprised us for one, but it drove it up, that loss ratio.
And do you have, and possibly this is embedded in slide 13, but do you have the percentage of risks ceded to the grid pool the number of risks ceded to the grid pool as a percentage of the total grid population? Is that?
It is possible. Ryan had mentioned 160,000. I thought it was 170,000, but I might be thinking of a different year. But yeah, you could do certainly the percentage of 62,000 relative to 160,000.
I'm just wondering how that percentage has changed over time. But
it certainly has changed because there was stability in the number generally of total risks from the marketplace that were going into the grid. So it hasn't changed dramatically from about 170,000. It's come down a little bit, as Ryan pointed out, relative to the entire marketplace, but the marketplace is growing by about 100,000 vehicles per year for a number of years. So we've seen a substantial decrease in the percentage of grid-rated risks that have been ceded to the pool. What we are seeing is that, again, from a projection standpoint, and what we're seeing early on in 2016 is that there are more risks coming into the pool, is kind of stopping that trend that we had been seeing.
Okay. And last question related to Uber drivers. How do they end up in the pool? How do they handle with respect to the pools, or any differently? Or?
Yeah, the world's evolving and our industry is evolving along with it, isn't it? Right now, because it's it's called ride sharing, but it's not ride sharing. It's cars for hire, and so they're not eligible for the risk sharing pool. That's in our manual. And if they come to us through residual market segment, right now, we're rating them as taxis because essentially that's the way they're behaving. Over time, we might develop a separate rating class for. I'll leave that to Sean and the underwriting team as well back at the shop to figure that out. But one of the things that as we've been thinking about it, as has everybody in our industry, but we have to be very careful that we don't lead the market. So we've had member companies step forward with programs for Uber that have been in the trade press. You've seen those. So we might change, or that's not an announcement, we're thinking about it, looking at it all the time, our approach to Uber, but right now, we're rating them as taxis.
Okay.
But just to be clear, to the extent that you have an Uber driver who hasn't told their insurer that they're an Uber driver, so that the insurer is not aware, and independent of that knowledge, the insurance company has transferred that risk either to the grid pool or to the non-grid pool, it will be in the pool. Again, not from our knowledge. Now, I think, Dave will have to correct me on this, I'm not as clear on the plan of operation, but my understanding is that if the insurer did not have that knowledge and a claim did come up, that claim would be honored within the pool. We wouldn't make that insurer take that risk out of the pool and not make that claim. But
it comes back to insurance contracts being contracts of unequal knowledge. And so, yeah, to the extent that we know about it, we'll rate it as a taxi, but there's a lot of behavior out there that our companies are not aware of, and Uber driving is, of course, one of the key ones hitting the headlines these last 18 months or so.
Thank you.
Any other questions? Well, thank you, David.
Thank you.
Yeah. So we look forward to hearing from you again, Sean and David. Thanks very much. Chris, are you ready to go?
Yep.
We certainly have, we've got 10 minutes. Maybe not.
Maybe not.
Okay. All right. So we are going to break a little bit early for lunch because some people may have had other conference calls or meetings for that period. We will reconvene at 1 o'clock as scheduled. And Chris, you'll be first up, followed by TD. Thank you. Okay.
time flies. Yeah.
We'll be getting started in about 1 minute.
But I did put it out this year, and it changed, and I thought I'd put it out so hopefully you want to read it ahead of time. That's right. You will, as I've been called. So how's your new management doing?
So if everybody could take their seats, I'll ask Chris Daniels to start his presentation. Welcome, Chris.
Thank you. I just love this position is right after lunch. Thank you, Alan. You know, like everybody's sort of, Okay, wakey. All right. For those that don't know me, my name is Chris Daniel, and as the consumer representative for Alberta, I'd just like to say I think my role is fundamental, that the consumer has a right to be heard and represented in the decision-making process, thank you, that affects the grid and the industry benchmarks that will be used to review insurers' rate filings. Okay. You know, I've got to do two things at once here, right? Can you do that? That would be much better, thank you. As you can see, I really appreciate the support of staff. Okay, automobile insurance coverage and insurance premiums are not always well understood by the public. And I think I'm just going to read, and maybe some of you did see the article in Thomson's in June of this year, and it was related to the UK, and I thought it was quite relevant here, and it said, amongst other things, and it was done by the co-op, no relationship to the Canada co-op. Motor insurance can be complex, and the research has found that drivers are often confused by it. Only 42% of drivers really understand their insurance policy. I thought that was kind of relevant, and I think it's relevant in Canada as well, especially from some of the discussions that I had with individuals, which I'll go into a little bit later. The position of the consumer representative is relevant and pertinent to the AIRB. It provides a barometer of public perception back to the board and maintains a sense of reliability in somewhat sense of reality in a internally and somewhat internally focused industry. Okay, how did we go about really garnering information and the public perception of how they feel about automobile insurance in the province of Alberta? So the first thing we do is try and ascertain a number of people that have relevant and pertinent information regarding how they feel about automobile insurance. And so we wanted to assess 800 Albertans. In order to do that, we actually contacted 9,000 individuals in order to get the correct amount of 800 that we were looking for. And that's based in Edmonton, Calgary, rural areas. And so those individuals are made up with a combination of that. We also did a number of focus groups in Edmonton, Calgary, seniors, personal telephone interviews with rural Albertans, consumers who wrote and called, and I personally interviewed 43 individuals. We also added this year a new dimension, and that new dimension was a youth area, aged between 18 and 25 years of age. This was, I think, a very relevant and important aspect to how people feel about automobile insurance. If we turn the clock back to, and we've talked about it a little bit this morning, if we turn the clock back to 2003, I think the preeminent chrysalis amongst what happened then was the youth group, and unable to obtain what we call realistically priced automobile insurance for those individuals. And so we felt, or I felt, that it was important to gauge their feedback. And I'll give you some of their feedback as we move on. Some of the questions we did, the survey questions, we developed some 20-odd questions with the help of a professional research company. This is done to ensure relevancy and accurate information is obtained from the consumer. So some of the questions are those that we've had in previous years, and some are new. Relevant questions, what did we add? We added the transportation network company as a question. That's relevant, it's important, we get their feedback from consumers. A lot of other questions are questions that we've had in previous years, but they form a barometer of how people feel compared to yesterday, compared to today. So driving in Alberta is not a privilege, but a necessity for all sorts of reasons that I'm sure you can understand. So therefore, the public still demand three key features in that: affordability, stable, and available. We also talked about that this morning. I think all the presenters, and including the board, has a concern, and that concern is expressed by the public in having stable rates. Obviously, as an individual, we all have our own budgets, personal budgets, and so therefore the public, sorry? Welcome. So the public don't like surprises, as nobody does, and I think that's what happened in 2003, and I certainly got that back from the public, as they want a stable, they want it to be affordable, and they also want to be accessible. Service is a key component of that, but only in relation to the, once they're insured, that they are getting service on whether it be on claims or on advice. What I found general focus on the focus groups, I think were the most relevant to me, the most relevant of all of the interviews that we did. And I think that's because the participants in the focus group clearly have opinions. And once you start the discussion going, you manage to open up and get their true opinions, as opposed to just asking a question and getting their immediate response. They like to talk about things. And so the more we talked, the more we got. And so some of the interesting observations were more discounts for better drivers, and we can talk about that with user-based insurance. More severe penalties for distracted drivers. The most vocal on that aspect was the youth group, which surprised me. Improved consistency in road signage throughout the province. If you go to Calgary, if you go to Edmonton, a lot of the signs are totally different. The Anthony Henday was cited as a real issue, whether you go north, south, east, or west. And if you don't know which way you're going, you end up going the wrong way. And that causes distraction for drivers. And so that's another reason why they brought that forward. Improved driver education programs, more emphasis on enforcement and detection of high-risk drivers. Those are sort of the key areas that came up. I'm now going to switch to the youth focus group. This was, a new addition. Didn't know how to go about it other than to get a group together between 18 and 25 who had insurance, who'd gone through the insurance process. And, you know, when you get a young person, they generally tend to follow their parents' risks or their parents' insurance. But once they get out on their own, then they find they want to buy their own insurance. So let's talk about a little bit what happened. As I said earlier, this was the chrysalis that started the 2003 crisis. So it was important to get their feedback. Well, I think we have to, first of all, compliment the insurance industry because they had, first of all, an excellent understanding and respectful of the ramifications of not driving responsible. So whether that's because of increased premiums, whether that's because of moving to the grid, moving to facility or the assigned risk. Interesting that the majority felt, and this is what was so surprising, that the majority felt the premiums were fair. I wouldn't have anticipated that. I didn't expect it. It was a shock that they all felt that the premiums were fair. 50%, over 50% had obtained competitive quotes, and they had done that predominantly through the internet. However, there was I think a major issue that they brought up was that when they went to the internet, they couldn't complete quotes. So what happened was they would get an initial premium and then it would stop, and then would say phone the agent or phone whoever, or for further information phone. They found this very frustrating because I think this group especially were very internet savvy and were wanting to complete the process and were unable to do it. So I think that's maybe a message going back, is that aspect needs to be better understood and a more complete process. The majority felt that insurance coverage offered assurance and security. I thought that was an interesting observation. They looked at it as though it wasn't just they had to purchase it. They were very conscious of what they purchased, and they felt it was also a major part of their budget was the insurance aspect, was the insurance premiums. Premium affordability, now going into that end, the general discussion with focus groups, they would like to know how premiums are made up. I think in this age of technology, we are moving away, and I shouldn't maybe speak from the board's perspective, but I will for a minute. We seem to be moving away from the old traditional driving to and from work, age, sex, miles driven, those type of things, to very much a computer program. Now somebody fills in the blank spaces and they get an automatic printout. So they didn't understand now how the premiums are made up. So I think that was one real key issue. How traffic violations and accidents, they wanted to know how much that affected the premium. Well, a lot of times they said they didn't know. This was the premium for 2 convictions. They would have to reprogram in and say this is one. Where I think in the older days they would say, well, it's a 10% surcharge. So it was simple. So the computers tend to generate the bottom line figure, but getting to the bottom line figure is not quite so clear. Couple of other things, better education. People want to have better education on all of the insurance aspects. So coverage, how the premium is made up, and the claims process, and how, when and when not to make a claim. I think that was another area that was brought up, was should I make a claim if it's only a minor accident? What is the cutoff? What would be my premium increase if I make a minor claim? Those type of things. And I think we need to concentrate on that as well. Revert, I put down here, revert to advice, less on the bottom line price. The nice thing I think is good is that as premiums have stabilized over the past few years, so has the consumer satisfaction level. And that correlates to the two. We've had a period, I think, since the regulations have been put into effect, and this is obvious by the feedback that we've been getting, is that the level of satisfaction has increased accordingly. So there's a direct correlation between the two. I think this graph speaks for itself. As you see, since 2015 compared to 2005, for the basic coverage, the increase has been just less than 1%. And additional coverage, the increase has been 40%. And so therefore, the total coverage has increased about 15% between 2005 and 2015. What I found on availability, first of all, we'd do a comparison of convictions with driving without insurance. And we don't have, unfortunately, the 2015-2016 statistics at the time that this report was prepared. However, should never look at one graph, as we've heard, and I'm not an actuary, but if we were the actuaries, you'd know that we cannot say one change does not make a trend, but there is something that it's gone up from 52 in 2014 to 2015. Is that because of increased law enforcement? Is that because there's all sorts of reasons that could be? So I'm not going to speculate and say that's a trend, but it's something as we move forward into the increases that will be happening, whatever those increases might be, that we have to be cognizant of the fact that there is a resulting effect, which could be driving without insurance. Premiums for high-risk drivers. This is always a contentious issue, but consumers feel high-risk drivers should pay more. That is a common sense, obvious statement. However, the risk is that if the premium is too high, consumers may drive without insurance, as we just said. Drivers paying for damage, even if not at fault, that also is becoming a factor, will become a factor. However, the concept of insurance, as I think we're all aware, is to spread the risk and spread the premium, not to make the premiums punitive, but to reflect the driving habits. And there's a fine line between that. And I don't think anybody has a crystal ball to say exactly what it is, but the public, I think, need a better education of that too. They feel if they are accident-free, then their rate should be the lowest possible. If you look at it from the other perspective, if somebody has a lot of accidents, they should pay an exorbitant amount. We saw that in 2003, and we saw that it didn't work either. Provincial premium comparison. We shouldn't, again, I think we're all aware here, but when we asked the question, do you feel Alberta premiums are fair and reasonable? And the way we phrased the question, and I think it's interesting to know, although the questions are in the book, is that we phrased it by saying, in comparison to your utility rates, in comparison to your taxes, in comparison to your fixed expenses of your home, how does automobile insurance compare? And the very, very high percentage felt that we're fair and reasonable, and that's where this comes from. And so I think that's obvious that the work that this board has done and the work that the industry has done over the years in changing the regulations has in fact brought a stability factor in insurance and a satisfaction level that is high. But when you compare, it's difficult to compare Alberta if you were to compare to Ontario, which has a totally different set of scenarios in a much richer remuneration, much richer much richer, what's the word I'm looking for? Much richer benefits that we have in Alberta. Saskatchewan, however, has a tort, non-tort area, and so therefore it's very difficult to compare premiums there. So we've got to be careful we don't just take those out of context. They have to be taken into context of what is being provided in other provinces. In general, customer complaints, as you'll see there, the Office of the Superintendent indicates call volumes remain stable. However, I would be amiss if I didn't say that a number of our calls recently to the AIRB have been concerning premium. We know that premium stability has been there on the average. However, if you look at individual submissions that we get, and then you look at individuals, some of them are faced with higher than normal increases because of circumstances. So the overall increase might be 7 or 10%. However, there are people that are individuals that are getting 30 and maybe 35%. Those are the people that are beginning to phone the AIRB. And we are seeing slight rise in that. Before, maybe placated by, did you have an accident? Did you have a conviction? No. Before, they would have that and could have that explained away. Today, no, their circumstances hadn't changed. And so if there was anything to say, is there a barometer out there? There are a number of people that, and those people are going to rise in the numbers, that are going to have higher than normal rate increases. Traffic safety was a topic that was discussed in the focus groups with comments relating, as I said before, to consistency of signage, direction, those type of things. Competition, survey of the 27% of consumers obtained as a competitive quote, slightly higher than previous years. Of those, 90% remained with an existing insurance, which is really good to see. They were comfortable with their existing insurer and they didn't just move for price. Some of them on the focus groups that we did indicated, yes, it may have been a few dollars lower, but they were comfortable with who they were. So you have less people moving and people staying. So I think that is a really good sign. Distracted driving, really interesting, I suppose, comments back. The largest comment back that were the most forceful was the youth group, who absolutely said they can't abide watching middle-aged and seniors looking at their phones. And I'm thinking, whoa, I'm sitting here looking at that. And I have always assumed it was the younger people that were guilty of this, but this particular group was adamant. I think they were well versed in the dangers of cell phone usage, whether it be texting or whether it be on the phone. Without question, they all want to see greater enforcement of this. I don't think we necessarily know the impact of cell phone usage out there on the frequency or the severity, more the frequency, obviously, of accidents. User-based insurance. Just the definition up there as we look at it. Again, a hot topic. I think in general, the consensus amongst consumers that any reward for good driving habit is welcome. However, should not be just a gimmick. That resonated with me. Was this going to be a marketing ploy from the insurance industry? Or was this a real added value where somebody could materially have an impact on their own insurance premiums? I thought that was quite good because we had never really looked at it as a gimmick or we've looked at it from very much a factual discount, potentially good for the consumer. But I think we should just be aware that the consumer is maybe a little bit more educated in some areas than we give them credit for. And they will look at this, unless it's presented properly, as a way to impact their own premiums and not just an advertising or a marketing gimmick that I have it and come on in. So I sort of took that home. Definitely the consumers want it and will be probably, I think we'll have a good take-up on this if it is handled right. Organized crime, we talked about crime this morning, so I'm not going to spend too much time on it, but Bill from IBC addressed it, I think, very well, is that Alberta has to be conscious that if they're, what was the word that Bill used? Whack 'em. Where's Bill? Is he gone? Oh, there he is. What did you say? Whack-a-mole. There you go. For every action, there is a reaction. And I think for every action that Ontario is taking in the way of organized crime, there's going to be a reaction and where else to look, but maybe Alberta is a prime example of that. So we have to be careful that we are prepared for it as we move down. The organized crime, I think in chop shops, we've seen it here, we've seen it in theft rings and those type of things. Okay, transportation network. This was a new question that we added. The Wikipedia definition is as said there. Not a lot of people that we interviewed had actually taken transportation networks, but I think without question it was over 90% were in favor of regulations. Alberta has become a leader, I think, in Canada in recognizing the need to protect consumers from the potential shortfall in insurance protection for transportation network users. 38% of the youth group, however, had utilized, and I think we see that because, again, they're technologically savvy. It's much easier to get a ride-share program, and so therefore, the other thing is I I think mostly did not realize the insurance implications of taking a ride that they didn't have insurance. And so I think this needs to be well publicized by the regulatory bodies, whether it's ourselves, whether it's the superintendent of insurance, whether it's the government. We need to publicly make the public aware of the lack of potential coverage by the superintendent putting this in. And I'll just switch to the next slide, which will give, I think you're probably all aware of this, but I'll spend 2 minutes, if I have that time on this, to give you a breakdown. And most of you are probably aware of it, but I'll just go through it again. So there's could be addressed 4 periods of the vehicle that is the ride share. So in other words, when the vehicle is just used for personal use, then basically their SPF 1 will provide protection for that. It's personal use, and they're not logged on to the transportation network company. Period 2 is where the driver is logged on for the purpose of providing a ride. However, they actually haven't accepted or using a ride at the time. This is where there could be a gap in coverage because at that point in time, technically, they are a commercial use because they are waiting for a ride. And so therefore, that then becomes a precluded use under the SPF 1 for business for hire or reward. Period 2, excuse me, has a driver, has accepted a ride and is en route to pick that passenger up. And period 3 is the passengers are in the vehicle and being transported. Alberta, I say, has been a leader in this in providing the SPF 9. There is a company that has developed coverage for that, and that is available to the transportation network and will provide that coverage. It is important to note that the individual driver must, however, obviously provide their own insurance for period 0. Be aware that they have to get the insurance from the transportation network and be logged in. Obviously, that's the case because they, in order to key on and get the ride share, that's an important tie. And there is an endorsement that has been allowed by the board and the superintendent for companies to add on that first period and that second period, so period 0 and period 1, for an additional premium. I thought that was a very interesting comment by the Facility Association on what could eventually happen to people that don't get insurance from their underlying carrier and in fact are denied coverage and then going into the risk pool, which of course is excluded, so they have to go to facility and they'll be rated as taxis. So I think that's an issue that we're going to have to look at as we move down the road. Is this becoming a real issue? Conclusion, auto insurance is affordable for most drivers. Rates are stable, that's good. The all-comers rule continues to be effective, and consumers indicate their experience related to customer service for both purchase of insurance and claims is favorable. I think the industry has performed very well, especially, and we heard this back in the focus groups. The Fort McMurray fire, the hail that we had in Airdrie, I think the industry has performed remarkably well. And a lot of good publicity came out, I hate to say that, as a result of a devastating loss, but a lot of good publicity towards the insurance industry has come out in that. And I think that's important because the insurance industry is never rated high on public opinion. Maybe that's an understatement. But I think that, in turn, was really, really good to hear back. And we heard that back from a number of times. Sorry, when I refer to we, I refer to Kimberly, who assisted me and kept me on track, by the way, because I tend to love to talk. But anyway, and it was very, very good. So it was nice to see that. Okay, considerations for the AIRB, I think, really haven't changed. Gradual increases. Gradual increases. We talked about it this morning. That's what we need. We don't need major fluctuations. The consumer doesn't need major fluctuations in their premiums. Usage-based insurance ensure that its rates for non-participants are fair. we had one particular individual in Calgary who had thought about this particular question and really came out and surprised us, that he said, well, what happens to the people that don't take the user-based insurance? And you're decreasing rates by 25%, and then all of a sudden, what happens to me? You don't take it. Does my premiums go up? And it was funny to see an individual actually bring this back up with no prompting. And it's something that we're going to have to wrestle with in the future. We're going to have to watch that that there is not a punitive damage, a punitive premium on the other side, that because participants don't participate. And rates for new drivers and those with poor driving records needs to be fair and not punitive. I think that's a question for the future. Okay.
I know that in earlier presentations you made to the board, we had the opportunity to give you questions, but is there any other questions that the board may have, or of staff and the actuary? I expected there wouldn't be more because we had a preview. So Chris, yes. I thank you very much for your. Oh, sorry. Yes, go ahead.
Consumers don't know if their premiums are capped by the grid. Is that correct?
No, they don't.
They don't know that.
No. Very little knowledge of the internal workings behind the scenes.
Do you know, the board, of course, has a grid calculator on its website. Do you know if consumers use that at all?
I would have to refer that question to Kimberly, who looks after that aspect.
40% of our traffic on the website is to the grid.
40%? Wow.
So that's quite considerable. Yeah. Good.
Thank you very much, Chris.
Thank you.
Appreciate your presentation. We have one more agenda item for today. It's we're going to have a presentation by TD Insurance. We have Mary Basirka, AVP Pricing, and Lynn Whitehead, Director of Government Relations, joining us. Welcome to our public hearing. Thank you.
Thank you very much.
And the floor is yours.
Okay. Thank you. So thank you very much for allowing us today to come here and present, as we do on an annual basis, to the board. As you just mentioned, my name is Lynn Whitehead, Director of Government Relations for TD Insurance, and with me today is my colleague, Mary Basirka, AVP of Pricing. So I want to take this opportunity to highlight a few items before we get into the real grit of the presentation that we have for you. As many of you may be aware, TD Insurance is a member of the TD Bank Group. We are the second largest financial services organization in Canada and the sixth largest in North America. TD is the second largest automobile insurer in Alberta presently. We have 15.5% market share for auto insurance, which translates roughly into 300,000 active policies, representing over $521 million in written premium for 2015. TD Insurance also is very much interested in ensuring that we're giving back to our community as well as helping our consumers on the front line. And in the past few years, we've contributed over $3.5 million in local initiatives, such as rebuilding High River after the devastating floods, in addition to some of the most recent helpings of those in need in the Fort Mac fires. And as I mentioned, the TD Bank Group overview of how we are. And we employ actually in Canada over 57,000 people, and North America wide, globally actually now is 85,000. So to further discuss the content of our presentation, I'll turn that over to Mary.
Great, thank you, Lynn. Great to be here once again. So in this presentation, is part of the deck, we show the loss trends for bodily injury. To begin. So we've made a comparison of the Oliver Wyman trends that we saw earlier today, and we see that for TD Insurance, the frequency is is zero for both Oliver Wyman and TD Insurance, and we see a similarity in the severity. So TD Insurance, using our own internal data, is showing an 8% trend on the severity side, which translate when the two are combined to 8 in comparison to 7%. Now, it's certain that it's difficult to make a direct correlation between what is causing this increase in claim costs. But there have been, as BI is certainly a complex issue, so we think there's a combination of factors at play here, and we'll see that in the next few slides. But mainly, there's the erosion of the minor injury cap, among other things. So what's, I think, of interest is that we are confirming the numbers that have been shown for the industry through OWs, and it's confirmed with our own internal data, and we've tried to delve into the possible explanations for this. So on the next slide, we'll start off with the comparison of fiscal year indemnity payments by accident year. So I'll start off by explaining what this slide is actually showing. So on each vertical fiscal year is showing the breakup of the accident years being payments in that fiscal year. So for example, in fiscal year 2011, so the AY0 that we see on the left would be the actual current accident year, so that would be 2011, and then PY0 would be 2010, and PY1 would be the 2009 accident year, and then for the fiscal year 2012, the AY0 would be the current accident year of 2012, and then 2011, and so on and so forth. So essentially, it's looking at all accident years on a comparative basis, and it's really looking at the payments made by TD Insurance within a given fiscal year, which for TD spans from November to October. So what's interesting to note is that for the fiscal year 2011 and 2012, we see relatively flat, or in some cases even slight decreasing payment trends. But as fiscal year 2013 kicks in, we see that there's an increase. Now, one of the main factors we think this is being caused by is the Sparrowhawk. So that took place, the decision was 2012, but obviously there's always a slight lag. So given it sort of spans the two years, we see it picking up in that fiscal year 2013 and onwards. So once again, no direct evidence is here, but it is a possible factor. So as you all know, the Sparrowhawk narrowed the definition of what would qualify as a minor injury within the MIR regulation. So although we see that trend upward, and we're only showing up until fiscal 2015, we believe, at least preliminarily, that it will continue into 2016 and contribute to a continued increase in loss costs for BI. So is that graph clear? Is it? So moving along, so another possible cause is plaintiff counsels using strategies to avoid cap limitations, and that would lead to an increase in psychological impairment and chronic pain awards or claims, which are also not capped by the minor injury regulations. So in this graph, what we're presenting also on a fiscal year basis is the number of claims or of new claims that have legal representation. So we see there's an increase of 23% from fiscal year 2013 to 2015. So it's quite substantial. So once again, no direct correlation, but one would expect that with increased legal representation, there would be an increase in claim amounts. So we do acknowledge that 2015 may be, higher than one would expect, but we do think that even though it seems to be much higher or potentially too high, we do expect an increase there. So what will that number end up being? Time will tell, but we do see definitely an increase. So moving along in the, always in the bodily injuries. So one other observation we have internally is that there seems to be an increase in the number of complex claims, and we're trying to measure that, I guess, by looking at the amount of the indemnities and how that changes by accident years. So what this graph is essentially showing is we've bucketed different ranges, so 0 to 5,000, 5 to 12,000, and 12,000 to 100, and then 100,000 and more. And we've looked at different accident years from 2008 to 2013, but at the same development, because otherwise we'd introduce an additional bias. So we've shown 24 to 36 months here, which is the most recent we'd have for the last accident year. And we see by if we look at the dotted line, within the 12 to 100,000, we see that, as the accident years progress, there is an increase. So in comparing, let's say, 2008, which is the leftmost bar, the lightest green, to the darkest green, 2013, we see that there's an increase there. And even more so, I would say, for the 100,000 plus, more claims seem to be pushed into that bracket, which would suggest that it would impact the trend, and we'd see an increase in claim costs there. So to wrap up bodily injury, so going forward, we do believe that the loss trends for BI will remain high. Once again, it confirms that what's been, what we heard all day. And we expect this to keep putting pressure on the claim severity for this coverage. So the increase in legal representation and counsel strategies to avoid cap limitations are expected to be the main drivers of this. And more recently, with the McLean versus Parmar decision that held that certain WAD disorders that are lasting more than 3 months are actually classified as chronic. We would expect that, although it's fairly recent and we don't know what the outcome, how this will translate into a claim cost, that it would tend to increase or drive up costs in the future. So as far as the other coverages go, so the loss trends, we've shown them here for illustrative purposes. We see that although not entirely aligned with those seen by Oliver Wyman, it obviously reflects TD Insurance's portfolio and mix of business. But what we do see is there's clearly a positive trend for all coverages. Comprehensive has its own specifics, which Oliver Wyman went into, and I can share the next slide as well. But essentially, the message here is that there is an increase in trends for all coverages, and different companies will have their own specifics driving the trends. So for theft in particular, we were asked this question or asked to comment on this previously, so we've shown this here as well. We see that although comp is comprised of different elements, theft being one of them, we do see that we've broken this one down into accident half years. So we see that more recently, from 2014 to 2016, an increase in the frequency of theft claims for TDI. So although, and this is purely anecdotal, but it seems this recent increase seems to be somewhat, the timing of it seems to translate to the economic slowdown. So, it will be interesting to see how this will, continue. I guess as more information becomes available and more data, we'll be able to confirm both for the industry as well as for TD Insurance. But we do expect that it is somewhat related to which would lead to potentially more opportunistic and behaviors and potentially crime and other, biases in the claims reporting and payments. So in conclusion, we agree with the majority of Oliver Wyman's reports as to the trends, especially in regard to bodily injury. We expect it to be very high, driven mainly by severity. And as previously mentioned, we can point to the Sparrowhawk decision for some explanation, as well as potentially the occurrence of very large losses and higher legal representation. And as mentioned, the Parmar decision seems to point in a similar direction and may further increase the claim severity for BI. For the other coverages as well, we see positive trends. So in closing, the last remark would be that in reviewing individual company filings, just to be very cognizant of the longer-term trends and how they can impact the consumer if, reasonable and steady rate increases are not allowed for the industry.
Well, thank you for your presentation.
Thank
I'd like to open the floor up to any questions from the board. Chris?
I know this is unfair, You don't get to ask me any questions, and I get to ask you, right? All right, there we go. Just maybe you could give me or us just a brief rundown of Fort McMurray in what happened as far as you were concerned in relation to the automobile aspect, and if you have found any issues that you haven't been able to cope with up there, or any particular points of interest to the board.
Issues in regard
In
to
settling of the claims, in the number of claims that you've had up there?
Well, I think obviously the main impact was on the residential side. I have not heard any comments about any particularities with the claims coming through on the automobile side. Glenn, I'm not sure if you did, but nothing.
Yes, so Mary is correct. I mean, a majority of our focus was on the residential side. With respect to the auto side, there were a few different elements of the auto. One, whether they were actually left behind and became total losses, and then of course it came down to the debris component of removing these vehicles. Two, whether they were partially damaged and it was about remediation of them. And three, whether these vehicles were actually abandoned on the side of the road due to the inadequacy of gas to be able to get from one place to another. So we've had some challenges, as I think other insurers probably have also had challenges with respect to the auto. We have had our numbers are changing because we are finding that as we've done some remediation, it's not adequate enough, and we're going to actually have to turn to a total loss of some of them because it's not getting them back to where they should have been. But it's difficult to respond directly with what we have personally done from a competitive standpoint.
No, that's okay.
But yeah, I mean,
challenges that you've experienced, I think of all companies have experienced challenges.
They have, and a majority of it that we're in right now is about the debris removal of those vehicles and where we're going to put them. Before, it was about the uncertainty of the vehicles and where they were being situated, because some were being towed to get them out of the emergency vehicles' ways, and so we're at that re-entry phase now. So.
Okay, thank you.
Any other questions? Ted?
Yeah, just a couple. First on that, is it slide 12, the theft?
Yep.
What does that 12% mean? Is that 12% growth rate per half year or per an annual growth rate, or?
It's on a semi, so it's 12% from over 2 years, yeah.
But it's 12% every 6 months, or
No, from the last to the last bucket to the 2014 to.
So it's 6%
Yeah.
on
Roughly,
average.
yeah.
So I reported, based on the industry data, a 50% increase in theft claim costs from 2014 to 2015. And you're only seeing, when the second largest writer in the province, only seeing a 6% increase?
This is on the frequency side, so I would have to validate, maybe it's driven, I think you mentioned there was also severity
frequencies
as
was the
well.
bulk of it, 30% of the 50 was frequency. I'm just surprised. And do you happen to know what the...
And was that, was that only theft, or was it
No, just theft.
Just theft thing, yeah.
And do you happen to know what the change was between the second half of 15 and the first half of 16?
No, I'd have to get back to you
I
on
guess
that
I can
one.
measure on that.
Yeah, once again, for the reason Lynn mentioned, we left out some of the details, but we'll be glad to share.
But could you just confirm that 12%?
Yeah.
Is that right? It just doesn't feel right compared to the industry data we're looking at. And my other questions have to do with slide 8, the loss trends legal representation.
Yes.
First of all, the 23% again is the change from the fiscal year 13 to fiscal year
That's right.
15. Okay.
That's right.
And do you happen to know what the the levels of legal representation are? This is the growth rate, but what are the?
I do. I can
Okay.
get back to you on that.
And you mentioned that, or implied that the increase in legal representation causes claim cost increase. Do you know if the claim adjusters, when they realize the claimant is being represented by legal counsel, are the case reserves adjusted upward for that, or?
Well, the procedures usually call for, not only judgment, but for adjustments to be made as more information becomes available. So,
Right.
yes, we do have claims handling, but ultimately, the outcome would be different if there's the legal representation or not. So that's what we're trying to.
But a claim adjuster, knowing that the claimant's being represented by legal counsel, bump up the case reserves faster? Or?
I would expect they would, yes.
And do you happen to know if the increase in legal representation is causing claims to take a little bit longer to be reported and also longer to close?
Yes.
Yeah, so it affects
Yes,
the patterns.
exactly. Yeah.
Okay, thank you.
Thank you.
All right, no other questions? Well, thank you very much, Mary and Lynn. We appreciate you participating in this year's annual review.
Thank you.
All right. Just some closing comments. So I'd like to say on behalf of the AIRB board, I would like to thank all those who presented and provided written presentations to the board today. The board will be taking the information that was presented today into consideration and will deliberate the settings of when setting the industry benchmarks, which will be used in the review of insurer rate filings effective October 1st, 2016. Today's presentations will be posted on our website, which is www.arb.alberta.ca following today's meeting, and will be available for viewing. A recording of today's presentation will also be available on our website no later than August 30th of 2016. Following today's meeting, the board will consult with our actuary, Oliver Wyman, to determine any additional information that may be required to finalize our 2016 annual review report, which must be posted on our website no later than September 30th, 2016. In addition, the information gathered today will assist the board in setting the grid entry level rates effective January 1st, 2017. The grid establishes a maximum premium for basic coverage for all driver profiles. It protects drivers from rates that may make insuring a vehicle prohibitive. Again, I would like to thank each of the participants for assisting us in gathering information and data to support our decisions. I hereby call the meeting closed. Thank you very much. Excellent. Safe travels for everyone that is, I guess, flying. I think it's a beautiful day to